Ladies and gentlemen, welcome to the UBS Center Forum for Economic Dialogue. My name is Carolyn Roth. It's an honor to be moderating this event once again. Thank you so much for your trust, for having me. And thank you for being here. And I heard that today we have a record number of signups, and that only speaks to the program that's been put together by the UBS Center. Of course, we'll be talking about many themes that are relevant to you and absolutely topical in this, let's call it the very uncertain world that we live in right now. Of course, we will talk about global trade, what's next, how are businesses faring and adapting to this, and of course, secondly, we'll talk about the state of the financial system, whether there are any cracks that are appearing, and thirdly, later on today, we will be discussing the role of the US dollar going forward. And as always, I'd very much appreciate if you, ladies and gents, would be so kind to interact with me, with everyone here on the podium. And you can do it through many ways. You can either raise your hand, old school. You can type in your questions. We'll give you a QR code. I'll get it here on my iPad. And then, of course, you can always participate in some of the polls. And we want to just try this out as a little icebreaker, kind of gauge the temperature in the room a little bit. But before that, quick look at the program here. As you saw that we have, once again, a list of highly distinguished speakers with us today from the world of academia, central banking, and business, of course. So there you go. As promised, this is the program. We'll have different panels, we'll have keynotes, and as always, time for you to put questions to the speakers as well. And we've got the first polling question for you. Which factor poses the greatest long-term threat to the global economy? Is it protectionism, trade wars, financial instability, geopolitical conflict at large, or environmental pressures? I'll give you a little bit of time to make your selection. As always, there's no right or wrong. Just really want to gauge how you're feeling about the greatest threat to the economy at this point in time. And as soon as we've got some answers, let's show you the results. There you go, geopolitical conflict, probably not a big surprise, 44%, 27% goes to protectionism and trade wars. We will be spending a lot of time on that very topic, on trade wars and the future of the rules-based order, which, as we all know, has seemingly been upended by one particular gentleman who happens to be the President of the United States of America. Now, of course, we also want to talk about the state of the financial system, and I think there's no one better to do that than the following and our first speaker. He is the former governor of the Reserve Bank of India. He's also the former chief economist of the IMF and currently a professor of finance at the University of Chicago Booth School of Business. Ladies and gentlemen, join me in welcoming Raghuram Rajan.
Thanks very much. You might ask, what has global trade in crisis, what's next to do with financial instability and financial system? Well, it's the what's next, okay? Let me give you a sense of where I'm coming at this. We know the global order, which involved open trade and investment, has been weakening. Of course, the current US administration is just the latest sort of blow to this, but it's also been weakening because of, for example, actions by China, which in the past have vitiated this order. We can talk about the details in the discussion afterwards. But importantly, it has been weakening because of domestic policy difficulties. We have never, whether in industrial countries or in emerging markets, paid attention to those who have been hurt by trade to a sufficient degree. We've always said, well, economists say global trade is good, yes, but it also has winners and losers. And even though on net we think the winners have enough to compensate the losers, that compensation has never really taken place in an effective way, except in a few countries, which small open economies like the Scandinavian countries and perhaps Switzerland. But in many other countries, it hasn't taken place, and the sort of concern about the global order has increased from there. At the same time, there's been a lot of anger about the global elite who manage economies. Certainly, the global financial crisis created a lot of concern that they didn't quite know what they were doing. And as a result, I think there's been a lot of questioning. When they say global trade is good, when they say openness is good, do they really mean it? Or is it self-serving? Are they protecting themselves because they benefit from the importation of goods and so on, but they're not subject to the kind of competition from global products that we, ordinary people, face? And of course, in this turmoil where the current sort of economic system is being questioned, there's also the geopolitical risk that many of you talked about, which is, for the first time in a long time, we've had two hegemons who are competing for turf. This competition was never serious when the US was going against the Soviet Union. The Soviet Union was really an economic midget, even though it was a military superpower. It was never serious when the US was competing against Japan. Japan was economically much stronger, but was militarily dependent on the US for protection. For the first time, the US has a military and economic superpower to contend with, and there does seem to be a question of whether there's place in the world for both of them. So there are lots going on in the world. And of course, we've had a whole disruption of the global order by the US administration, tariffs on, off, on. Now there's some question whether the Supreme Court will say they should be rethought. But despite all this, there still is very little effect to be seen in the United States on either growth or inflation. You would think if there's so much policy uncertainty thrown against the economy, it would show up somewhere. And it still is not really showing up in a big way in either growth or inflation. Some of this is because policy was anticipated, and so firms reacted. For example, getting ahead of the tariffs by importing goods. Inventories have built up quite a bit as a result. And also the consequences of policy uncertainty, I postpone investment. Well, that takes time to show up in the data and maybe something to come. But there's also been a lot else happening. Even as we have all the trade uncertainty, there's been a huge investment in AI and AI-related sectors such as power. And that construction boom, equipment purchase boom, has lifted a lot of ships. It's been huge in the sense of, at this point, it's probably 1.5% to 2% of GDP in terms of the increased investment that is visualized for next year. And that's a big number. So that's on the positive side. On the labor market side, in the US, we've had an immigration crackdown, which certainly has meant that whatever jobs are being created in the economy, they are, even though much lower than they used to be before, maybe enough to absorb what is left of people looking, people coming into the labor force. So in some sense, the labor market hasn't collapsed yet. That unemployment rates haven't gone up. That's because even as demand has come down, you've also shrunk supply. And as a result, there is a sort of tenuous balance there. Again, the operative word is yet. We're starting to see some cracks in the labor market. We're starting to see more layoffs. And this is something that may become bigger over the course of the year. And lastly, there's been a huge fiscal stimulus through the Big Beautiful Bill, which is going to show up in corporate balance sheets early next year. And that's something which is going to be on the positive. So certainly two positives, one negative, or one question mark in terms of other stuff that's happening even as trade happens, which is why perhaps we haven't seen a lot reflected in the data. Of course, the government shutdown also increases uncertainty about the situation because we don't know what the real situation of the US economy is at this point. Let's see if I can get this to, okay. There's a lot of uncertainty right now. But even as there's a lot of uncertainty, some of you are asking the question, why are financial markets celebrating? Stock prices are really very high. If you look at credit spreads, they are at a narrow, certainly many-year narrow. And if you look at speculative assets like cryptocurrencies or gold, very buoyant. And of course, there's a boom in mergers. It looks like everything's hunky-dory and the markets are celebrating. Interestingly, the Fed always talks about conditions being restrictive. And that is a reason for the Fed to start cutting interest rates. But if you look at what are sometimes called measures of financial conditions, taking everything into account, including spreads that are being charged to borrowers, including stock market levels and so on. If you look at a comprehensive measure of financial conditions, it hasn't tightened over the entire course of the Fed tightening. Financial markets in the US have been celebrating, and newer forms of credit, including private credit, have expanded hugely. You might have thought that the pandemic, which was a downturn, would have squeezed some of the excesses out of the system. But there was a huge amount of fiscal and monetary support during the pandemic. Very, very few businesses went bust during that time. So it's not clear the pandemic squeezed out any of the excesses. And now, after that tightening, which didn't seem to have much effect, the Fed is starting to cut interest rates again. So the Fed is cutting into strong credit conditions. What is the Fed worried about? It's worried about potential labor market weakness, worried that it will get blamed for a downturn, certainly being set up to be blamed for that. And also there's a tremendous amount of government pressure on the Fed to think about cutting rates. So in the face of all this, there is pressure on the central bank to cut. But it's not clear that, in fact, conditions are sufficient for it to cut. So what I'm going to do, given that the theme of the UBS Center is to tell you a little bit about academic research, is tell you a little bit about what academic research tells us about monetary policy in these kinds of situations, and then conclude with some, I will have to go fast given the time we have, but let me try and get you on board. So one paper it helps to start with is a paper done after the global financial crisis, which examines 154 business cycles in 14 countries. And what these authors do is look at business cycles that coincided with the financial crisis. And 35 of them coincided with the financial crisis, and they asked, well, which crisis was worse and why? And they focus on excess credit, which is a measure looking at whether a particular crisis involved more credit to GDP than in the normal credit expansion. So did you have more credit expansion before the crisis? And what are their findings? Not surprisingly, financial crisis-based recessions were worse. Okay, that's because the financial system also got into trouble at that time and wasn't able to fuel the expansion. But importantly, it was related to how much credit expansion took place before the crisis. The more the credit expansion before the crisis, the worse the downturn. And this is the slide that makes it clear. Sorry, okay. It seems to be lagged. What you see in the dark line is the normal recession. The dark line basically says normal recessions, the economy goes down and recovers quickly. The dark line below that is a financial crisis recession. And what you see there is it goes down and stays down for a much longer period and then comes back. And every dotted line below that is where the credit to GDP was higher and higher still. So the worst crises are the ones where credit to GDP before the crisis grew really fast and then things tanked. So too much credit is bad. That's the message you want to take away from this, especially if it results in the financial sector falling into difficulty. Now, let's step back a second. What does this have to do with monetary policy? Well, a whole bunch of studies after that went to look at monetary policy. Where did this credit come from? Was it in a situation where monetary policy was easier or tighter? It turns out very interesting. This is a paper by Grimm et al., which basically says, let's take a measure of the stance of monetary policy as the real policy rate that's in effect minus what might be the policy rate that would create an equilibrium in the economy. Let's call that the real neutral rate. So the difference is when policy is tighter than what would be necessary for equilibrium, this would be positive. When policy is looser than what would be needed for equilibrium, this would be negative, okay? So that's all you need to take away, tighter, looser than equilibrium. And what did they find? They find, again, I need 2 minutes more because of lags in the slide. They find that, one, so on the left-hand chart, what you have is the average stance of monetary policy before the crisis. And the red line on the left-hand chart is what happened before the US, before the global financial crisis. That's the US policy before the global financial crisis. What you see is a U-shape. Why does the U-shape explain what happens? The first part of the U is when policy is being cut, okay? That's when you're setting off the credit expansion, which creates the underlying conditions for the problem. There's huge credit expansion. And then when you find that, oh, credit is expanding too much, you start tightening. And it's the tightening phase which causes the collapse. So the U-shape is seen in real numbers. And what you see on the right-hand chart is credit expansion. Credit expansion is happening. It really takes off as the U-shape you're going down, and then when you come up, it basically collapses the system because at some point you need more and more credit to keep it going, and it makes the system collapse. Now, they did it with real interest rates. Others have done it with nominal interest rates. Again and again, the U-shape starts showing up. It's the easy times when the problems are built up, and as you try and tighten because inflation has gotten too much, et cetera, the system starts backing up, okay? In the interest of time, I'll skip the slide. It's basically saying the same thing. Look at this in different ways, and what you find is easy money foretells with higher probability a crisis in the future, okay? So be careful about running money too easy because that creates potential problems. Now, a classic example of this is the crisis, the global financial crisis as it happened in Europe. Why is it a classic example? Because in the core countries, inflation was relatively low. We're talking about Germany, France, et cetera. Inflation was really low. So ECB policy, when measured for the core countries, meant a relatively low, a relatively moderate real interest rate. The policy was right for the countries at the core. But for countries at the periphery, Spain, Portugal, Ireland, where inflation was much higher at that time, it meant a negative real interest rate. Policy was too easy for countries at the periphery. Which were the countries that suffered a huge credit boom? The countries at the periphery. Which were the countries that didn't? The countries at the core. Of course, the core country banks lent to the periphery, and so the crisis migrated to the core also. But the point here is that because the ECP was running a common policy, it was different for the core and the periphery and created very different impacts. And here again, you can see, take just one example. I need to go get closer to read it. Take total credit. You see the periphery, which is the blue line, it goes up hugely. In the core, it doesn't. And that's because policy was much easier in the periphery, and we know they suffered the brunt of the crisis. Now, of course, there's a real question. Why do low interest rates, whether nominal or real, precipitate the kind of credit risk increase, the risk-taking, that creates the problems down the line? Okay? Now, people have done sort of research in the lab trying to show there is a behavioral component to this. For example, when interest rates come down from a high risk-free interest rate to a low risk-free interest rate, when the central bank is cutting interest rates considerably, then at that point, it might look to households, this is work done by my colleague Joran Ma and others, it might look at that point that interest rates have come down a lot. When interest rates have come down a lot, even though it's coming down because inflation has come down, etc., you might sort of get a little confused and say, I'm not getting the same kind of nominal interest rate that I was getting. I was getting 5%, now I'm getting just 1%, and you reach for yield in an attempt to increase the interest rate you're getting. Okay, so you can find this kind of behavior in the lab when you run it. It's also that when the interest rate is 5%, the additional spread you get from taking more risk, maybe a percentage or 2 percentage points of additional spread, doesn't look that big. 5% is large, 7% is a little larger, but it's not that much more. However, when the interest rate is cut to 1%, and you're still getting the 2% risk spread, 3% looks a lot compared to 1%, and you stretch out on the risk spectrum. So that's the point about salience. Other arguments for why people take risk when interest rates are really low, for example, any institution which has fixed liabilities will then search for yield when its assets are generating low interest income. It's going to search for yield, and that's a common behavior. It's a behavior we see even now. So search for yield certainly is one way that this happens. Another is, if at these times money gets reallocated across the system, the entity is getting a whole lot of money coming into theirs, especially banks. They don't know what to do with that kind of money which is coming into their coffers, and they typically end up making bad decisions. A classic example of this was in the 1980s, when we had a whole lot of banks getting the petrodollars coming from the Arabian states, coming into the big multinational banks. And what they did was they recycled it to Latin America, and those weren't great credit decisions. But you can see this in the microcosm also preceding the global financial crisis. A bunch of banks saw an increase in deposits. What did they do with it? They couldn't lend it to their normal borrowers because those borrowers already had plenty of credit. So they went out and searched for new borrowers, made those loans, and ended up making big mistakes. And there's also, in these times, when everybody's making money, making loans, and earning the fees on those loans, there's a fear of missing out, right? Remember Chuck Prince, the chairman of Citibank, just before the global financial crisis, when asked, aren't you worried about the risks? He said, well, the music's still playing, and so we have to dance, right? Many years later, I met him at a conference, and I asked him, so why did you say that? You have the most memorable quote from the crisis, and not in a good way. And he said, look, the real problem was that nobody knew when the party was going to end. But if I had called it and told my M&A people, you can't get any more credit at this point, you can't, it's just too risky, they'd have walked across the door, they would have walked out of the door to my competitor and joined their M&A group, and they would have been very happy to hire them because everything was red hot. And so I had the choice of either saying, I know this is going to come to an end, let's stop now, or the music's playing and let's continue, because if I called it a stop, I'd have lost a chunk of my staff. Seems plausible, but it is an issue that, that one has to worry about. Let me, thus far I've been talking about interest rates, but what is important is also to understand that today central banks don't just play with interest rates. They also play with liquidity because they can expand their balance sheet and put out reserves. Reserves are the most liquid asset in the planet. So they're increasing liquidity in the financial markets when they do that. And when they shrink it, they're reducing liquidity in financial markets. And central banks have been doing the expansion, what is called quantitative easing, and shrinking over the last few years. And some people think this is a free extra instrument. I would say it also contributes to the same kind of risk-taking phenomenon. It is used to stabilize financial markets and also used when central banks run out of interest rate policy because they hit the lower bound. But it has consequences that they have not anticipated. One of the consequences is as they flood the financial markets with liquidity, it turns out you haven't reduced the frequency of liquidity shock episodes. In fact, they seem to have increased, which seems strange. You're flooding the market with this really liquid asset, but you have the opposite consequence. September 2019, the US markets backed up. March 2020, they backed up. March 2023, they backed up. April 2025, they backed up. And October 2025, they backed up again, which is why the US has stopped quantitative tightening. It says, you know, the market needs ample reserves, and let's stop now. Interestingly, when the US Fed started expanding its balance sheet in 2008, the size of reserves was 80 billion. When they stopped quantitative easing, it was about 1.7 trillion, and then they brought it down to about 1.4 trillion, and they had to start it up again in September 2019 because the system was backing up. Okay? Then they expanded it hugely. And recently, they started reducing the size of the balance sheet, but they've stopped. What is the size of reserves now? 3 trillion. So from 80 billion, it's gone to 3 trillion. 3 trillion is now considered enough for the system. Why does the system require so much? Because liquidity is like a drug. The more you get of it, the more you want. And what do I mean by that? It means that you know, when the central bank expands its reserves, banks have to hold it. It's costly for banks to hold reserves because they're low-yielding assets. So they try and use them. What does it mean to use them? Basically, first, you issue short-term liabilities rather than long-term liabilities because short-term liabilities are safer when you've got a lot of reserves to protect you. So banks have moved more to demand deposits to finance the reserves. They also go to firms and say, you want liquidity? I will write you a line of credit. When you need the liquidity, I'll be there to give it to you. So lines of credit have also expanded hugely, written to firms. And banks have also increased their funding of speculation. The kind of leverage that is implicit now in speculative bets like the covered, what they're doing in the bond basis trade, the kind of leverage that's there is the kind of leverage you had before the global financial crisis in banks. Huge, 50 to 1, 100 to 1 leverage there. So what's happening is all this liquidity is being used by the banks to provide liquidity to the system, which means when the Fed withdraws liquidity, the system says, hey, don't withdraw too much, because we've used up all that you provided. And that's why $80 billion of reserves was enough in 2008, 1.4 trillion in 2019, 3 trillion now. It keeps going up. So what's the worry? Well, the worry is each of these, basically, if the central bank expands reserves, let's see. Okay, when the central bank expands reserves, the supply that it creates its own demand, and basically makes it much harder for the Fed to pull back. But the system really becomes extended. And when there's plenty of liquidity in the system, every asset price moves up, every credit spread narrows, and leverage moves up in the system. So what's to worry now? Basically, one worry is that, the system is getting stretched. And when the system starts imploding, bad things happen, because you get financial sector entities getting into trouble. And, to some extent, we've become really reliant on the central banks. The Fed has always said it will help the system out when the system gets into trouble. And it has done that most recently in 2023 when the Silicon Valley Bank got into trouble with, cutting interest rates if possible, with special facilities if possible, with additional liquidity. The problem, however, is when the Fed keeps doing this, it makes the problem worse because the system knows the Fed will come in. Okay. The system knows the Fed will come in, and it undermines discipline in the Fed. So with that, the question is, how do you reduce that problem? How do you make sure that when the Fed comes in to help the system, it actually does the right thing? Well, there's a famous book by Walter Bagehot, who used to be the editor of The Economist. And he had a famous line in that book, which is basically when the central bank comes in to bail out the system, it should lend freely against good collateral. So it should lend to solvent entities against strong collateral that they have, but at a high price. Okay? That high price was very important. Well, what we've done with the central bank's intervention is always we've lent freely, sometimes against good collateral. In the last lending spree when the Fed intervened after Silicon Valley Bank, it wasn't against the full value of collateral. But what is important is it's never charged a high price. If you do theoretical models, the high price it should charge is the price the private sector would charge. That's the price that keeps the financial system honest. But politically, it's very difficult for the Fed to charge that high price when it intervenes. So it always intervenes at a really low price, after which the banks say, you didn't help us. We just got out of this on our own. Where was the help? It turns out that if the Fed really wanted to keep them on the straight and narrow, it should charge a really, really high price. So that high price is hard to charge, whether you charge it ex post when you intervene, because the banks are in trouble then. You don't want to charge that high price. It's hard to charge ex ante when you provide insurance. Whenever the federal deposit insurance builds up equity, builds up profits, the bank's always saying you're charging too high a premium, reduce those premiums. The point is, it's very, very hard for the public sector to charge a high price. And so the net effect, and I'm going to go to the last slide now, the net effect is that central bank intervention, because it's always done at too low a price, turbocharges the effects of accommodative policy. And people have studied this across central bank interventions over time. And not surprisingly, central bank interventions helps avoid the current crisis, but always creates a higher probability of a future crisis, because the private sector then comes to see the central bank as a support. So let me conclude, because I'm really out of time, if I can get to the last slide. Okay, so we can't afford another crisis. That's not surprising, but it's also something we can't afford, because the kind of fiscal space governments have is not what it was before the global financial crisis or before the pandemic. Today, most industrial countries are at 100% of GDP, debt to GDP, and some much more. So in this kind of situation, you don't have the kind of government fiscal space to back the central bank if it intervenes in a big way and takes on a variety of credit risks and so on. So while the central bank should try and prevent risks from building up by using macro-prudential tools to prevent banks, for example, from taking that risk, that may not be sufficient. Macro-prudential risks may be weak if at the same time you're pushing on the monetary policy accelerator. So in a sense, you should take into account overheating, credit expansion, etc., when also doing the monetary policy setting if your macro-prudential tools are not enough. What does this mean for today? And that's my last point. Today, we are in a situation where credit is starting to build up. Asset prices are high. Yes, maybe the labor market is somewhat weak, but there's immense investment going on from the side of AI, etc. At this point, for the Fed to contemplate cutting more and more in interest rates is getting us back to that point of the U shape, where the U shape, the first phase of the U where you're cutting interest rates, sets in play the kind of credit risks that come back to bear when you start raising interest rates. We haven't dealt with inflation yet. We are cutting interest rates. Perhaps we also should be worried about the financial system and the risks it's taking, even as we deal with everything else that's happening in the real system. Let me stop there. Thank you.
Mr. Rajan, thank you so much for this. This is a pretty ominous warning that you're giving us. Also, your questions, ladies and gents, of course, are welcome, and I see that some of you have already written in. But let me just start, if I may, because you said the credit extension is going on, it's increasing, but what's different this time, many of us would argue, is that it's happening when it comes to the private markets, private credit, not necessarily banks' balance sheet. Doesn't that make it even more dangerous because the Fed is toothless here? What's your sense here?
It's a great point. Yes, private credit has been expanding. Some say it's partly regulatory arbitrage. The big banks, because of capital requirements, etc., find it actually easier to lend to the private credit suppliers, and they then on-lend to the final borrowers. And so it's not that the banking system is immune from this. It's fully engaged, but you're not seeing the next stage, which is regulators don't regulate the private credit entities. And the quality of that is certainly an ongoing issue. We've already seen some concerns. But I would say that the issue is not today. The issue is what happens in the next couple of years. On the one hand, we've sort of, in a sense, got a combination of 2001 and 2008. 2001 because of the frenzy of the internet. Now we have the frenzy over AI. And 2008 because of potential credit ballooning out. And they come together in the sense that today many of the superscaler AI companies, they used to finance a lot of their AI investment from internal sources, from the immense profits they're making. Now they're going out and they're saying, we're going to outsource this, we're going to create special purpose vehicles, etc. All that is going to be dependent on AI demand, which is a big unknown. How much, when, is it going to be in the right places? Those are all questions that need to be answered for us to feel comfortable about this kind of lending that is starting to take off now. Mm-hmm. So I think it's early days, but it's the time we should exercise caution.
In other words, you're saying, just to invoke the quote from Prince Chuck again, the music is still playing, we don't know when it stops. Remember back in 2005 in Jackson Hole, you presented a paper on the risks to financial stability. I don't think anyone wanted to listen to you back then, and that was a couple of years before the crisis actually hit. Are we a couple of years out? At which point are we right now, and what should the Fed, in an ideal setting, without political pressure, what should it be doing? Should it stay put or should it even hike?
Well, even when you trade off inflation versus growth, it doesn't have enough evidence growth is falling through the floor. Even now, as I said, AI investment is huge. And even if you look at consumption, upper middle class consumption is quite strong in the United States. Lower middle class is falling off. They're people who are hurting. But by and large, the economy is still being supported on both consumption and investment. They're concentrated, they're not spread through the economy, but overall growth is pretty strong, which is why inflation is 3% by most counts. Last few months, because of the trade effects, it's gone up to nearly 4%. It probably will stay in the upper levels of 4%. Or mid-levels of 4% until mid next year. That's what people are contemplating, seeing the pass-through of goods prices into inflation. For the Fed to be cutting in that environment, yes, I understand the insurance cut, but the insurance cut is 1, maybe 2, not an extrapolation of cuts. And so in the absence of more data, I would say it's particularly dangerous to keep cutting, especially when financial markets are so exuberant.
Mm-hmm. But again, that's where the political pressure comes in. And of course, we know Jay Powell will be replaced next May. Final question for me, because what's happening in the US, and you repeatedly say that the US growth is not falling off a cliff, but what we're seeing is a very peculiar K-shaped progression. The higher earners, they're doing pretty well, but the lower earners, they're not, obviously, because they're suffering. So what Trump is delivering to them, the people who voted him into office, is not a rejuvenation of the industrial basis. What he's delivering is an AI boom.
Yes.
Full out, AI boom. But
yes.
He's not delivering for his key voters, is he?
He's not, because, well, in parts. So yes, some factories that were GM factories that were in Canada will come back to the US. That's the old style auto worker job, but of course even those jobs have been highly automated. So now it's more looking after the machine rather than doing the work instead of the machine, right? So that's what's happening on the job front. But I mean, where he has delivered is on immigration. So he certainly has cut down on immigration hugely through measures that you may or may not agree with, but that's certainly cut down immigration. But this, in fact, is creating scarcity in some areas, construction, for example, where, in fact, you're sort of hurting overall growth in the economy. It is, however, in the longer run, some of those jobs will become higher paying as a result of the scarcity of workers, and that may help some of the moderately skilled workers who are his base. But in the short run, are we seeing a huge growth in jobs at that level? No. These are people who are hurting even more because of the fact that the tariffs, for example, are creating more inflation and eating into their disposable income. So one of the messages from this recent election was, you haven't fixed inflation, which you said you would.
Absolutely. Let's get to some audience questions. Many of them here, the audience can actually vote on the question that they like most. One of them being, can developing countries still count on global trade as an engine of growth, or has that window closed? What do you think?
Well, Ralph was telling me, which I thought was very, very important, Ralph Osa, is that 75% of trade still goes on as before. The fact that a 15% behemoth is putting also...
Don't spill the beans, that's the next panel.
Yeah, that's why I didn't talk about trade at all. He's going to talk about it. But that gives you some hope that if the rest of the world sort of talks... Now, there is one caveat, which is that if China, which was exporting to the US, finds that not only the direct exports are affected, but also the transshipments. Now, that's a huge issue because China hasn't reduced its exports. It seems to be exporting through some of the emerging markets and developing countries to the US. If the US cracks down on that, then where do Chinese exports go? They have to find a place in the rest of the world, and then the rest of the world starts reacting to that. That may make global trade much more fraught than with just the US reacting. But let's say the US can't stop those transshipments, then maybe all we've done is reconfigured global trade a little bit, but much of it goes on as before. What I find particularly interesting is that the US has done everything it's done without the rest of the world sort of forming any kind of coalition to say, look, this is bad and we should resist this and maybe together. But it seems like the divisions in the rest of the world make it very hard for them to come together. I think in the longer run, there will be these new groups that form, new kinds of trade agreements that form, etc. I think it will still be, less good than having a single trade. But bottom line, I don't think the developing countries are going to, it's going to be devastating. It'll be bad. But that comes on top of a pandemic, which was really bad for them.
We'll debate during the next panel as well. How important is it for central banks to act independently from executive government interference? I assume you'll say extremely important. Can I just ask you about your experience as the governor of the RBI? Because you were under some political pressure as well to keep rates relatively low, I assume.
So there's always pressure on you to cut rates. And so my whole effort during my governorship was to create an inflation targeting committee, because it's harder to pressurize a committee than to pressurize one guy. I was the guy who determined interest rates.
Did that work?
We did form a committee, and India's inflation has stayed within the band for the, whether it was the committee which did it, it was a success. But my role was to hear them, and then to tell them why it couldn't be done. Because the argument was always you have to cut interest rates. But importantly, they knew that if inflation took off, they'd sort of have to bear the brunt of that. So they put the pressure on you, but you could tell them no. When you said yes, it was because you thought inflation was manageable. And so they were willing to give you that freedom. You decide. We're going to keep pressuring you. We're going to keep telling you, not the way the US president is pressuring Chair Powell, but certainly in private, why aren't you doing it? Why aren't you doing it? All my business friends are telling me that interest rates are too high. How come you academic think you know enough that you're not doing it? I mean, all the usual arguments. And you say, look, wait, be patient. I will cut when the time comes. And you did it. I mean, but you have to stand up to pressure. Well, fortunately, I had a job in academia also. So I could always think, well, if I get fired, I can always go back to academia.
I call that a perfect hedge.
That gives you backbone. That gives you backbone. But you have to have backbone. It is a job with enormous pressure.
Mm-hmm. And of course, the former central banker is in the room, and he will know about that pressure. And in terms of standing up to that, he's still getting important calls. No, that's not your phone. Let's get some audience questions in. Okay.
Yeah, so you highlighted the dangers of loose financial conditions, and you emphasized the political economy constraints that come from the sector itself, the financial sector, lobbying for lower rates. I was wondering whether you had any thoughts on another source of lobbying in the same directions, which is governments, which I think now, given the level of indebtedness, are basically hoping for inflation, which is going to get them out of the corner where primary surpluses will never help. Is that a underappreciated dimension of the buildup of loose conditions that we see?
I think it's underway right now. I can think of at least one central bank which, let me not mince words. I think the Bank of Japan, with debt to GDP as high as it is, Japan benefits from higher inflation than normal if it's unexpected, because that reduces the size of the debt burden that they have. And I'm not saying this is what the Bank of Japan is doing, but after a huge period of low inflation, they've been resisting the notion that inflation is now finally here to stay. And incidentally, it's been very helpful for bringing down Japanese debt. How much of this is, I don't think it's so much government pressure as the central bank trying to, work things out so that it doesn't sort of act too soon in an environment which is actually favorable for macro stability because it's reducing the size, the real value of the government debt. That said, there's a danger of letting inflation get too high because then you have to really increase real interest rates to the point where that's the killer. Real interest rates, which are very high, would make high levels of government debt really unaffordable. And you don't want to get to that point. So there's a balancing act. But the point is, as soon as you start considering government debt in your equation, you have what is called fiscal dominance. It's not just growth and inflation that you're thinking about, but you're also thinking about government debt. And that makes monetary policy even harder to set, let alone thinking about the financial sector, which I'm adding as yet another part of the equation.
Prabhuji, in your first or second slide, where you did the analysis of the situation as it is, you mentioned about instead of one, we have two hegemons. Both of them are not feeling happy on the basis of two is a company, three is a crowd. But do you think now more than two, more the merrier, will be much better for the global trade instead of two if we have four, for example?
I think, we have to deal with the fact that the two are much bigger than the rest, except for the EU, which is less well coordinated than the two separate countries, both of whom seem to be under fairly robust or authoritarian leaders. I think what would be an important message for China to hear from the United States is, we are not here to undermine your growth. We are happy for you to grow, even if you overtake us. We just don't want you, we want you to follow the rules of the game. That message is something that, perhaps would be great for China to hear. And it would be great for the US to hear that God didn't give you the single right to be the largest economy in the world forever. At some point, other countries are going to overtake you, but that's okay because you have so many strengths which are going to still keep you one of the richest countries in the world for a long, long time. But, so what if some other country becomes bigger and maybe even militarily more powerful? Each hegemon has to get used to the other one being comparable. And unfortunately, neither is used to that. And that's where the fight comes, right? China thinks the US is completely broken as a system and sees its opportunity. And the US thinks China is not behaving by the rules and wants to therefore use every means it can to keep the other under. How do you get a bipolar world? Probably that word doesn't. How do you get a bipolar stable world? And that requires acceptance on both sides of each other's relevance and importance. Right now it is, I'm going to try and keep the other from exercising any influence. And that's not going to work.
And another audience question that ties into this, where does India fit into all of this?
India is relatively small. It's at this point a $4.25 trillion economy. About the size of Japan, probably overtake both Japan and Germany in the next year or two. So as a country, it is big, but relative to the two hegemons, it's still quite small. I think the hope that Indians have is the 6% growth that it has right now goes to 8% with the right sort of environment, and it catches up eventually to the two hegemons and becomes the third. But any kind of calculation you do with those kinds of growth rates means it's going to be 15, 20, 30 years before that happens. So I think it takes time for India to get really big, but can it be ignored? Probably not in the next 3 or 4 years. It becomes an important source of global growth, which is why India needs to do all the right things, including on the environment, that it has to become a more environmentally sensitive growth, which is what it's trying to do, is happening in some ways.
Obviously, Mr. Rajan, we'll be talking about tariffs in the next 2 sessions, and the Swiss got a pretty bad deal. I don't know if you remember, August 1st, 39%. Now, there's one country that got an even worse deal, India, 50%.
Yeah.
But I hear that things are moving. First of all, I don't know if that should make the Swiss feel any better, but someone else is worse off. But things are moving, right? Because you're buying less oil from Russia. Is that the way to please Mr. Trump?
So I don't think Russian oil purchases were ever the central issue. I mean, you just saw yesterday he waived the purchase of oil by Orban in Hungary. That's okay. I don't think that was the central issue. I think the central issue was more personalities. And especially a personality in the White House and how they treated certain comments made by India after, Mr. Trump claimed credit for stopping a conflict between India and Pakistan. Pakistan played it the right way, said that it was all because of Mr. Trump. India tried to argue that the two countries had reached an agreement without Mr. Trump. The truth is probably somewhere in between, but net effect was India got 50% tariffs, Pakistan got 19. I understand that there was some comment about how your leader in Switzerland tried to explain the tariffs to Mr. Trump, and that didn't go well.
So we don't know what really happened.
We don't know what happened.
A lot
We're
of
speculating.
Conflicting reports here.
Yeah,
but
we don't know what
happened
between India and the US, but hopefully the longer run sanity prevails on all sides and we all reach reasonable deals. There's no reason for either Switzerland or India to be out on a limb with higher tariffs.
You're absolutely right, Mr. Rajan. You saw there were so many more questions. We're out of time. I don't know if you have time to stick around for coffee. Please do approach him. Thank you so much. I really appreciate it, and we'll take a 30-minute coffee break. We'll be back with the next panel on global trade and what happens thereafter next. Thank you. Thank you. Thank you. Ladies and gents, welcome back, everyone. We hope you had a good coffee break, fruitful discussions. Now we are really going to dig into the theme of the global trade war and the fallout of that. And I've got with me my esteemed panelists. To my left, João Aguiar Machado. He is the EU ambassador to the WTO. He's also spent, I think, more than 2 decades at the European Commission. Thank you so much for being here. Really appreciate it. Then to his left, Ralph Assa, UBS Foundation professor at the University of Zurich, and of course, former WTO chief economist for 2.5 years. Always a pleasure having you on a panel. And last but not least, Hélène Rey. She is the Lord Bard Professor of Economics at London Business School and the Center for Economic Policy and Research Vice President. Thank you so much for your time as well. Before we kick off with a number of inputs from these panelists, I want to ask you a question, ladies and gentlemen. Please get out your phones once again. The question I have for you, and then maybe later on the panel can reflect on that, is international trade entering an era of permanent decline? Yes, no, or only in specific areas? Is international trade entering an era of permanent decline? I won't show you the outcome just yet. I'll just leave a little bit of suspense in the room and see what this room thinks. And let's listen to the experts now with a few inputs. Ralph.
Well, thank you very much, Caroline. And I was actually looking forward to finding out now what you think, whether international trade is a permanent decline. I can tell you right away, I don't think it is. But that's not what I'm here for today. What I'm here for today is to give you a quick overview, my own take first on the current situation, then also what I think the implications are for international trade, and lastly, what I think the key priorities should be now in terms of our policy response. So let's jump right in and take a look at the current situation. And the main message that I want to get across is that yes, US tariffs have risen sharply, and yes, this is a serious problem, but it is a problem that has limited reach, much more limited reach than most people appreciate. So if you start with the chart on the very left, what you see is the US average tariff. It's a trade-weighted average tariff, and as you all know, it has gone up significantly. And this is important. First, it's important because the average US tariff is now as high as it has not been for many, many years. You have to go all the way back to the 1930s to find comparable tariff rates. So it's clearly significant. It's also significant because it's not just any country imposing these tariffs, but it's the United States, which has traditionally been one of the main sponsors of open trade and more generally the rules-based trading system. So I just wanted to make that very clear. Of course, there is a serious problem. What's a little bit less known is what I show in the middle, which is that the US is actually not as important in international trade as many people think, including, at least you get the impression sometimes, the United States government. So what you see here is world imports, merchandise imports, and what share of world merchandise imports goes to the United States. And what you see is that only 14% of world merchandise imports go into the United States. 86% go into the rest of the world, which means that the rest of the world collectively is much more important. And one implication of this is that, of course, it's important now to come to terms with the United States, to find cooperative solutions with the United States, but not at the expense of rules-based trade with the rest of the world. And if you know that, then you may also not be so surprised about what I show on the right-hand side, which is that most of global trade continues to be rules-based and not power-based. And I think it's so important because everybody talks about the end of the rules-based order, everything being power-based. And again, I'm not trying to minimize the problem. Oops. Oh, no, you're still there. Sorry. I'm not trying to minimize the problem. But if you look at it, you see that 72% of world merchandise trade is still conducted under the tariffs negotiated at the WTO, the so-called MFN tariff, and the remaining, I have to look carefully now, remaining 16% is conducted under preferential trade agreements, so not agreements that are negotiated at the WTO, but agreements that are consistent with the rules-based trading system. And only 12% is really what I would call non-cooperative. That's essentially the US tariffs and the responses by other trading partners. And that's an important point, because if you realize that the rules-based trading system is still alive, you also realize that there's a great danger in not acknowledging that in policy conversations, because it can easily become a self-fulfilling prophecy. If we all think, well, nobody's following the rules anymore, then of course we might be tempted to now also not follow the rules, and then this can become a self-fulfilling prophecy. So clearly a major problem, but a problem so far with limited reach. Now, what is this going to do? What are the implications of the tariffs that we currently have? And here again, you see a bit of a mixed picture. Well, of course, if you impose tariffs, that is going to slow down trade growth. According to the latest estimate of the WTO, the tariffs cut global trade growth by half. So in the latest forecast, the WTO Secretariat estimates the volume of world merchandise trade to grow by 2.4% this year, 0.5% next year, so combined 2.9% over 2 years, which is about half what they would have expected without these tariffs. What's interesting, by the way, and that relates to what Raghu was saying in his keynote at the beginning, that actually this year doesn't look so bad. So really, we would only expect the real consequences of these tariffs to become visible next year, simply because there was a lot of front loading, there was a lot of trade that took place in order to avoid these tariffs, which, by the way, in April, when I was still responsible for the trade forecast, we didn't quite anticipate. So this is quite a correction from what we had in April. So then, my last point: what is important now in terms of the policy reaction to this situation? And for me, if you remember the first slide that the tariffs come from the main issue are the trade relations that involve the United States. And if you also remember that that's a relatively small share of global trade, for me, the key priority now is that we make sure that the trade tensions, which are relatively isolated, that they don't proliferate to the rest of the world. And I see two particular channels through which such proliferation could take place, and relatedly also two main risks. The first risk is what I have in the first column, are basically trade deals with the United States that are discriminatory. And I have a picture here of von der Leyen, but that I could have put any other picture. Basically, what you see is that all trade deals that have been signed with the United States, at least the ones I'm aware of, Japan, South Korea, European Union, UK, Thailand, Indonesia, and so on, they all share the characteristics that the countries made unilateral concessions to the United States without extending the same concessions to other trading partners. So these are discriminatory deals that come at the expense of third countries, which of course could provoke trade tensions, but they also go against the key principle, I would argue, of the WTO, which is a principle of non-discrimination, that you're not supposed to discriminate against other countries. Now, again, of course, I completely understand that countries want to come to a cooperative solution with the United States. I'm just pointing out that that should be done in a way that does not jeopardize trade relations with the rest of the world, given their importance. The second channel through which trade tensions could proliferate are trade diversion effects that are not well managed. And the big concern, of course, are Chinese exports that used to go to the United States that might now get diverted to other markets, including the European Union or also Switzerland. And this is clearly an issue, so I don't want to debate it away, but I want to put it in perspective with 2 points. The first point is that bilateral trade between the United States and China accounts only for 2.4% of world merchandise trade. Yeah, so generates 80% of the news, but less than 3% of world trade. So there's a cap for how bad these trade diversion effects can be in the aggregate. Doesn't mean it can't be important in steel or it can't be important in cars, but in the aggregate, not that important. And the second point I want to make is that these trade diversion effects are, of course, bidirectional. It's not just Chinese goods that need to find other markets, but it's also European, it's also Japanese, it's also European goods, Korean goods that need to find other markets. So I think there's scope to handle this cooperatively. And then just the last point I want to make is that, of course, another proliferation risk is not a geographic one, but a sectoral one. So at the moment, the trade tensions are limited to goods, not services. Services now account for a little over 1/4 of international trade. And it's a bit of a mixed bag because on the one hand, services trade, that's where some other countries actually have some leverage because the US is a net exporter in services. But of course, this is also where the escalation risks are high if you think about finance, big tech, and so on. So with that, let me already conclude. So key takeaways first, yes, we have a problem, but the problem has a more limited reach than many people think. Second, of course, the trade outlook has deteriorated, but we are not going to see a collapse of international trade given the trade tensions that are in place now. And third, let's be careful how we manage this. Yes, let's try to come to terms with the United States, but not at the expense of deteriorating trade relations with the rest of the world.
Ralph, thank you so much for this. Any questions to Ralph, please put them or type them into the tool, and I will put them to him later on through my iPad. Hélène?
Good to see everyone. Delighted to be here on this panel with my distinguished co-panelists. So I'm going to take it where Ralph has actually left us, and in fact, set a little bit more of a stage in terms of the importance of these trade links between, in particular, the US and the rest of the world. So what I'm showing you here is a trade network in 2000. So it's year 2000, it's before China gets into the WTO. And you see these big nodes, which are the countries. The biggest one here is going to be the US, but you have also the European Union, and you have a number of important nodes. But the size of the nodes is proportional to export and imports of these countries. And the arrows that you can see indicates the exports from one country to another country or region. And you can see that there is a lot of density in that network, and that's before China enters the WTO. Now, if I move forward towards 2019, you're going to see the change in the network here is pretty striking in terms of trading goods. You see that now we have been moving from a network in which there were two big nodes, which were the US and Europe, essentially, with three big nodes, which are the United States, China, and Europe. So we have gone really to a world which is really tripolar as far as international trade in goods is concerned. And you can also see that the density of these connections of a network has actually also gone up. So we are really living in a very, very interconnected world. And I want to contrast this trade in a goods world with another network in the international economy, which will make also a link to with what Raghu has been talking about in his lecture, which is the international finance network. So here, what I have is a network which is based on cross-border investment, what we call portfolio investment in international finance. So it's investment in securities. It can be stock, equity, it can be fixed income. Okay, these are securities, and these are the cross-border positions. So again, you see these big nodes here. You see the United States, very much in the middle. You see Europe, which is quite important. And in that network, this is also year 2000, you cannot really see China. Right, it's somewhere it's a small node in the periphery. The size of a node is also, proportional to the size of the cross-border investments. And so you can see China is very small. And actually, if we move towards 2019, now what is interesting is that the US and Europe are still very much interconnected and very much kind of in the middle of a system. And China has grown. Maybe you can locate it in this graph on the periphery, but it's actually not that big compared to the two others. So we are still very much in a world in which the US is dominating in international finance, Europe is important, and China really has not caught up. So that's a very different, there's a very big asymmetry between the world of international trade, in which we are in a tripolar world, and the world of international finance, in which really we are still in a world dominated by the US, with a sizable also role for Europe. Now, this is the interconnections as they were in 2019, 2020, and what has been happening, and Ralph has been talking about that a lot, is a number of shocks, very important policy shocks. So the trade war, we also had obviously COVID and the Russian invasion of Ukraine, very important shocks which are reshaping to some extent these networks. And so how are they reshaping them? Well, we start to have a number of very interesting academic papers looking at that from the point of view of firms. And what I am showing you here is some work which has been done using earning calls of firms and asking companies, what are you doing because of the tariffs? What are your reaction to the tariffs in terms of relocation of supply chains? And then I will show you some other type of actions that firms are taking. But so here the first thing is, what is happening to these networks, this international trade network? And what we can see is that in reaction to the tariffs, firms are changing indeed their production network. They relocate out of China to a large extent, to some extent into the United States, but very much into the so-called connector countries, Mexico, Vietnam, Malaysia. So instead of trading directly from China to the US, you have the supply chain going through essentially these connector countries. So you have different, longer supply chain as a reaction to what is happening on the trade, as far as the trade war is concerned. So that's for the supply chain responses. But there are other types of adjustment that companies are taking. Some adjustments are, well, for the companies, the US companies, which are affected by the tariffs, what is happening for them, this is firm in the sender country. In the case of tariff, this would be, for the Trump tariff, this would be the US. They are in the sender country, and the receiving country would be China, for example, or Switzerland. So firms in the sender country, in the US, what are they doing? Well, they see that the cost of their input is going up, so they increase their sale price. That's one of the major type of response. But what is very interesting is that you see that firms in the receiver country, and that's going to be, for example, Chinese firms, in response to export restriction in particular, what are they doing? Well, they are increasing investment and they are increasing R&D. So there is increase of technological innovation to try to somehow bypass a little bit these trade shocks that are being imposed upon them. All that does have negative effects. By the way, you can see that on profit margins. You can see that at the very right of the slide. It hurts both firms in the sender country and in the receiver country. But you can see that there are two types of adaptation, via the supply chain and via technological innovation and R&D, which is happening. Now, in parallel to this reshaping of network because of a trade war, because of a tariff, because of the export control, because of the financial sanctions, there's some other things that have been going on inside networks. So here, what I show you is a totally different type of network. This is the supply, in a way, the trade network for one critical mineral for green transition, which is lithium. But I could have taken any of the other critical mineral for electrification. What has been happening in between the 1990s and now is that China, very interestingly, has managed to position itself very much in the center of these mineral networks, of these trade networks for critical minerals for electrification. Not necessarily because China is mining them, but China has preference supply of these minerals, processes them, and then consumes some of that and re-exports some of that. So there's really a kind of China has moved to the center of this network very much. So to some extent, the way I would characterize what has been happening in terms of policies vis-à-vis trade and to some extent vis-à-vis finance is the comeback of coercion in the international arena. We can see this is a very old concept that goes back to Albert Hirschman, effectively, which is effectively, you can position yourself in trade networks. You can use tariffs in order to try to constrain other countries to do certain things. Okay, that's the concept of coercion. This is very much a kind of in the geopolitical realm, and there's a lot of papers written right now on geoeconomics in academia, which speak to various aspects of these issues. So in the aggregate, if we look at trade, we may not see actually much of a decrease in trade, as Ralph pointed out, but what we do see, or seem to see, is a change in the shape of these networks. Okay, and I think that's important to realize that. And both the change in position and the increase in R&D, the technological innovation, are about increasing sovereignty, resilience to geopolitical risk. Now, if I just, to finish, talk a little bit about international finance, I think this has implications for currencies and international finance in general, because as we have just discussed, we used to have, China-US trade directly, and so that would be done mostly in dollar. Now, if we go China, Mexico, US, or China, Vietnam, US, there is scope for more currency competition, in particular for the RMB. And at the same time, the geopolitical tensions have also stirred in various parts of the world the emergence of different payment system in order to increase sovereignty. So that might or might not lead to further fragmentation on the international finance side. As far as the role of the US dollar is concerned internationally, so this increased competition is there, definitely. The fact that we might see also an increase in cryptos, which may or may not decrease transaction cost. If it does, if it decreases a lot of transaction cost across many currencies, then that makes the so-called vehicle role of the US dollar less relevant. What is the vehicle role of the US dollar? Is the fact that if you are Malaysia and you want to trade with Mexico, now essentially you trade, you use your currency against the dollar, and then you use the dollar as an intermediary to buy Mexican peso. So you go through a vehicle currency. It's like going through a hub. When you take a plane, you fly through Chicago, and then you fly from Chicago to somewhere else. You go through a hub. In international currencies, usually the hub is the US dollar. If we decrease transaction cost across the board, then that may decrease the vehicle role of the dollar, and that may therefore decrease the role of the liquidity in dollar overall in the international economy. Now, that's one possibility. Another possibility, as we have seen the US administration pushing US dollar stablecoin a lot, is that on the other hand, we see more dollarization of the world economy. So I think one of the big questions is whether US fiscal dominance is extending to international finance and international trade, in the sense that the US having big budget deficits, it's now using a lot of tariff revenues, to decrease its deficits. And it's also pushing US dollar stablecoin explicitly in order for more people around the globe to buy US treasuries. So that's a very different types of motives in the international arena compared to what we had before. And finally, very last slide, maybe we have seen a warning shot for the US dollar. Here, what I have done is that I put side by side markets' reaction in long-term bonds, so 10-year bonds, and exchange rate for two big shocks. The first one on the left was COVID, and the second one on the right was the Liberation Day shock, so the tariff shock of April 2nd. You can see that my little arrows, they go in the opposite direction. Why? Because at the COVID shock, we had the typical reactions of market. US is a safe haven, meaning everybody was going into US treasuries, and the dollar was appreciating. That's what it means to have all these points in the northwest quadrant here. Everybody flight to quality into the US dollar. That was the COVID shock. And you see on the right, my arrows are pointing exactly the opposite. it was actually after the Liberation Day shock, depreciation of the dollar, people getting out of US bond markets into the rest of the world. So exact polar reactions, very unusual. It hasn't happened before. Usually global shocks, the US is the safe haven. Liberation Day, it was the opposite. So maybe that's a warning shot. Let me stop here.
Thank you so much. Ambassador?
Thank you, Caroline. And first, I would like to thank the UBS Center for the invitation to be here. It's a great pleasure to me. Well, we are witnessing right now the major overhaul in the international economic order and trade order of the last 75 years. The system that was created in the aftermath of the Second World War, based first on the General Agreement on Tariffs and Trade, the GATT, and later the WTO, relied on open trade based on rules-based trade, creating stability and predictability for business, which is essential. And this created opportunities for increasing export in the post-war period and created prosperity worldwide. I agree that we realized later on that there was inequalities that were not being addressed by domestic policies. Trade cannot correct that. Now, this order that was created and led by the United States now has jumped outside. The US is applying arbitrary tariffs, even to islands with penguins, as you know. It's using tariffs as a way to obtain concessions and to force countries to change their policies. And at the same time, we have other countries that are using the dependencies that were created to weaponize trade. I'm speaking about the critical raw materials and the export controls that we are witnessing. So we are moving from a rules-based order into a power-based order. I agree very much with Ralph that the vast majority of international trade is still being conducted on the basis of WTO norms, and let's hope that we can isolate the US problem and that the others continue to trade respecting the rules. I have my questions about it, because we have not yet seen the side effects of the US policies on the others, and Ralph touched on it. For example, if China starts deviating exports into the European market, I can tell you this will be a huge problem. So we have not yet seen the consequences of the new policies of the US will have on the others. So I have doubts that hopefully the system maintains, even if the US is sitting outside, but very likely as we go further, there will be political pressures on governments, and you know how it is, politicians saying, well, if the US has abandoned, why are we respecting? So it will be a difficult climate that we will be living. Now, the European Union remains fully committed to the WTO system. We are participating in reforming, in discussions to reform the system, but it will be a hard time. It will take many years, in my view. For one thing, the whole architecture in the post-war period was led by the United States. And now to lead without having the US, in the past it was US and EU that essentially led the negotiations. Now that US is sitting on the sides, but still being a member to make sure that nothing progresses, this is going to be a tough job. It will be. What I'm trying to say by that is that even if we can preserve the rules of the system for trade among the others, I don't think we can expect the WTO in the coming years to be the forum where you negotiate new rules. New rules to address the current issues, be artificial intelligence, climate, or other issues, will have to be negotiated elsewhere. With 166 members and the huge divisions, I don't see any prospects. Now, in the face of this volatile and changing environment, what is the European Union doing? Essentially three things. Number one, we still remain very committed for trade. For one simple reason. The European Union is very dependent on trade. We are a collection of nations that are traders. We know that world growth, economic growth, in the next decades would be generated outside Europe. European growth is very insipid these days. So if we want to continue to maintain our social model and economic growth, we need to be connected to these outside markets. Therefore, we need to be trading with them. We export a lot. Trade contributes a lot to the GDP of the European Union. And we also import a number of inputs that are necessary, just so that you know, 2/3 of European Union imports are intermediate inputs. Many of them go into products that we also re-export. So we need to be connected to the world. And we have already the biggest network of trade agreements in the world. We have about 44 free trade agreements with 76 nations. And we are continuing. Recently, we concluded with Mercosur. I know that EFTA also has negotiated and concluded. We are going to sign next month the agreement with Mercosur. We have recently concluded with Indonesia, and we concluded also with Mexico, an upgrade of the old agreement. On top of that, we are pursuing negotiations right now with Thailand, Malaysia, Philippines, Indonesia, we also concluded recently, and United Arab Emirates. Thirdly, we are doing, on top of these comprehensive agreements, more sector-specific agreements. For example, we have done recently on digital trade with Singapore and South Korea. We have done with Angola and South Africa sustainable investment trade agreement. So we are also doing more sectoral agreements. At the same time, we need to manage the relationship with our two most important trading partners, the United States, where we continue discussions because the negotiations are not finished. We continue discussions with the US, trying to be constructive and positive, but looking also at the interests of the European Union, as it should be. It's not easy, but we continue to engage regularly. Secondly, with China. It's more difficult, it's more challenging, because the Chinese continue very much with an economic policy that is basically state-led, that induces overcapacities, and that is very much tech-dominant, and that reduces the space to find areas of convergence. The dialogue continues, but is very challenging, the discussions that we are having with China. Now, we have learned during the last couple of decades that relying on open markets and only on free market mechanisms can be dangerous, because it brings prosperity, but it creates a lot of dependencies. And the European Union has learned firsthand that creates terrible problems. We created dependencies vis-à-vis Russia for energy, oil and gas. We created dependence with China for the market, and now the raw materials. And we created dependence with the US on security. And this creates a situation that is not sustainable. So the second plank of our strategy right now is economic security. We are developing a strategy. Unfortunately, today I cannot go much into details of it because it will be published next month or beginning of January. It's planned to be in December. For the first time, we are devising an economic security strategy. How to deal with these dependencies, what sort of instruments we have and which ones we need to create. because we are in a world that you cannot be completely dependent on others, and we need to minimize these dependencies as much as possible. The third plank of our strategy is to complete the single market of the European Union. The single market is still not very complete as far as services are concerned. And one of the big deficiencies that we have never yet overcome, and discussions are ongoing, is to create a capital market, a capital union, whereby right now there are a lot of savings of European citizens, but they found their way into the US for the pension funds and others that are going to finance the startups in the US. We cannot tap on our savings because they run across the Atlantic. And a big discussion happening right now in the aftermath of the reports of Draghi and Enrico Letta that were published last year is to complete the single market, particularly on financial services and on the capital markets union, which is very important because, again, the European economy is not growing as much as necessary to maintain our social model. We need to increase productivity, and unless we complete the single market, we are going to face difficult choices in the times ahead. So this is the three-plank strategy that we are deploying right now in face of these very volatile and changing international economic environment.
Ambassador, thank you so much for that. And I do see that the EU has a plan in place. We're all crossing our fingers when it comes to the implementation of that. That said, we need to go back a couple months and talk about Scotland when Ursula von der Leyen struck that deal with Donald Trump. Was that really a good deal? Because you could argue that the EU at that point in time lost a large part of its credibility because it is a defender of the rules-based system of multilateralism, yet by signing that deal, it violated the WTO rules. What's your response to that?
Well, I mean...
And Ralph is laughing because that was your implicit criticism before, wasn't it?
No, it's a very good question. I mean, the EU, the multilateralism is an instrument, it's not a hand in itself. And the EU remains very much attached. The deal that was done with the US, let's be honest, it was the deal of the possible. And if you look at the deals that were done with others, and if you take into account the exemptions that were created, we are paying an average effective tariff lower than 15%. It's about 9%. The deal that UK made, the baseline is 10, but the MFN rate is not included. So in many cases, it's 10 plus 4, which is almost the 15 that we had to do. So if you look from that point of view, and I think it's the realistic, realpolitik, because in Europe the companies were ready to pay this surcharge, but to have predictability, as long as we can, as much predictability you can expect with this administration, you never know. But business wanted to have some stability in transatlantic trade. Of course, we tried, as good European officials, I can tell you, when we started the discussions with the US, was to say, okay, you are not happy with our trade, let's negotiate an agreement. We go to zero, both of us, for industrial products. And it went on, and several times we said, let's go to zero on industrial products. And at some point, the Americans said, you have not yet understood what is the game here. The game here, you go to zero, and I go to 15.
I mean, there was a lot. There was a lot going on. There was 0 for 0, and then there was the threat of the anti-coercion. There was the threat of taxing some of the big techs. But at the end of the day, it's pragmatism that prevailed, I assume. Ralph, let me ask you. Was that the right thing to do? Do you think at the end of the day, it's defense that trumped everything economic, no pun intended?
I mean, I do think you also have to be realistic about the realpolitik here and see what was possible and what was not possible. So for me, it's not so much about was it the right deal? Was it the wrong deal? Of course, I would have wished for something else. I can also be honest and say that it disappointed me and hurt me as a European to see something like that come to pass. But I think the key now is how do we present this? And I think what I would and what conclusions do we draw? And for me, now running around and pretending that this is a fantastic deal for both sides, I think that would not make so much sense. But I think just to see it for what it is and say, look, we were dependent in terms of security, in terms of needing the market, in terms of perhaps also access to some critical services, finance, AI, and so on. But now let's draw the right consequences. And I think one right consequence, and Ambassador Machado has said it very clearly, is to push forward with the completion of the single market, particularly the capital market union. Because, of course, everyone who has taken an economics class knows that the trade surplus of the European Union and of any other country is equal to domestic savings minus domestic investment. So if you want to do something about the trade surplus, you need to increase the investment in the European Union. And I think the obvious way to do it is by integrating European financial markets, which would be good for Europe, and it would also help alleviate the trade tensions. So I'm a bit of a, of course I can't be happy about the deal. I was shocked when I found out about it, but I think now you also have to look forward and you have to say, well, what do we do about it? Because it probably was the only thing that was possible at the time.
And I assume the goalpost or the perspective is changing all the time, because first the UK got the deal, that wasn't seen as great, then the EU got the deal, and the Swiss and the Indians got the short end of the stick, so they'd be happy to be in this kind of situation. Ellen, you talked about currencies, and that's quite interesting because the dollar, as you said, had a surprising move on the back of Liberation Day, and was no longer the safe haven or the trusted asset. And the EU, the euro saw a bit of a renaissance, if you want to call it that. Will it ever rival the US dollar? I know we have a bigger discussion on that later on, but in terms of the portfolio flows that you've seen, and of course a lot of it is around, the fiscal spending that's happening in Germany, can the euro really live up to this moment?
So I'm going to answer this question, but I just would like to add something to what my two fellow colleagues just said. I think to some extent the issue also with a trade deal that we have seen between the EU and the US clearly is because Europe does not have currently a credible independent defense. And so as long as the issues are going to be linked by the US administration, the bargaining power is clearly more in the US. And so the way for Europe forward is to build up the hand for bargaining, which is in particular to construct a credible common, as much as possible, European defense. I'm not talking necessarily about all countries, but at least something that is a reasonable deterrent. And I think that's going to be very important. That fits into the sovereignty themes that I also had on my slides here. Now you're asking about the euro. So indeed, we saw this very unusual movement of the dollar, which looked more like an emerging market currency than a safe haven currency, and that was a first. It doesn't mean that there were huge, or that there are huge continuous outflows from the dollar. I think what we saw is a reassessment of the risk of many investors who were very, very exposed to the US dollar. For many years, the investment, that's the famous dollar exceptionalism, the investment was US equity markets without hedging the currency risk, a joint bet on the US equity return and on the dollar appreciation, which did very, very well for many years. And so positions were very, very heavily exposed to this dollar risk. And as it became clear that the US administration is eroding some of the very important fundamentals of US long-term growth in terms of attacks of institutions, right? Independence of the Fed, for example, independence of the justice system, So corruption around the cryptocurrencies and all that, I think these issues have led a number of investors to be a little bit more skeptical about the long-run return in the US dollar area, and therefore both of rebalancing at the margin, but also of hedging the dollar risk. So there was a lot more hedges of the dollar, which led to a dollar depreciation. And I think this kind of long-term effects, doubts on the institutional setup of the US is still here. Which obviously does not mean that the euro is going to suddenly replace the dollar or the RMB, for that matter, even farther down the line. However, I think it makes sense for investors to be positioned a little bit more across currencies. And so the emergence of a bit more multipolarity, this, I think, is here probably to stay. The euro has a card to play. As we have seen from the networks, very big trading power. Financial markets are developed much more than in China. China has restrictions on the capital account, so that's really a big break on the internationalization of the RMB. But Europe has some homework to do, and it was just alluded by my fellow panelists. So evidently, we have been talking about this capital market union for the last 20 years. Well, how about we are doing it, right? You can call it savings and investment union if you like, but how about moving? I think that's really the right time. And I'm hoping that we actually see a little bit more of a sense of urgency here.
And I think we have over the past half year or so, definitely. I want to go back to the question that I posed in the beginning. Is international trade entering an era of permanent decline? And let's see how you ladies and gents, how you feel about this. Let's show you the results. It's evenly split. No, and only in specific areas. So I think that gives you some comfort, I assume, hopefully. And not everything is going down the spiral, and we can hopefully, put the US issue aside. But it still begs the bigger question, and I'm talking to you two gentlemen, how to reform the arbiter of international trade, that is the WTO. Is it still relevant? How can you reform it? Is Donald Trump right in his criticism?
Well, I don't think so. I mean, what you see is that after having experienced 30 years of the WTO created by the US does not feel that rules-based trade is in their interest. And they don't feel that a binding adjudication of trade disputes is in their interest. By the way, the US never accepted international jurisdictions, International Criminal Court, Human Rights Court. The only exception was the WTO. But after 20 years, they got cold feet and they said it's not in our interest, essentially because problems with China. So, and what you see right now, everything is bilateral deals. I don't think the US will be returning anytime soon, and this is not only something depending on the current administration. We already saw with the previous administration of President Biden, he more or less maintained the same measures that Trump 1 had adopted. Because very simple, once you create tariffs, you create interest groups, and if you are going to reduce them, you lose votes. So this is a situation, and it cuts across Republicans and Democrats in Congress. So this situation will remain. I don't think international trade will reduce. What we are going to see is a more fragmented international system within large areas of blocks. There will continue to be globalization. I think it's no question of going backwards, but you are seeing there will be, in terms of supply chains, try to reshore them closer to home, or at least to countries that you take it as more trustworthy, whatever that means, and try to re-engineer supply chains to bring them to more, or diversify them. So you will see not this globalism that you saw since the 90s, but you will see still a lot of international trade, but shaped in a different way.
Mm-hmm. Ralph, let's get to some audience questions. If the US is playing a diminishing role in global trade and we aim to reduce the dependencies, what is the rationale behind pursuing new trade deals with the US?
I mean, let me actually take the liberty and respond to a broader question that's related to it that I'm going to pose to myself, and then I'll come to this. So one thing I wanted to add, there's a lot of discussion here about the role of geopolitics in international trade, fragmentation of the global trading system. Joao has said it, Hélène has said it, and for me, I have to say that if you had asked me a year ago, I would have said geoeconomic fragmentation is where we're going to go. But now when we saw Trump going after its closest allies, Canada, European Union, and so on, Japan, I'm not so sure anymore. So I think the future is going to be much messier than geoeconomic fragmentation. I still think it's going to have the WTO at its core, but there's going to be some messy patchwork around it. So that's one point I wanted to make. The other point I wanted to make is that, especially as Europeans, we have to remember, I think, that the history of European integration is one of interdependence. I mean, think about it. When the Steel and Coal Union first came about, it was all about Germany and France becoming interdependent because they were enemies, not because they were friends. So it's like faux shoring, if you will, instead of friend shoring. And I'm not as naive as saying that, let's just reduce tariffs and everything's going to be perfect. But somehow this idea got completely lost, I think. We're all trying to become self-sufficient. We're all trying to only trade with friends. And what this means is you're investing in your weaknesses, because you start basically digging up rare earths in Germany or something like that. It's possible, but it's not efficient, rather than investing in your strength and becoming interdependent. But now very, very quickly to the question. So what I would advocate for in terms of trade policy is actually exactly what Switzerland is doing, also what the European Union is doing, is of course support the World Trade Organization, support the multilateral trading system, but also go for a wide variety of bilateral deals, including, of course, the United States, because even though the rest of the world is larger and more important in terms of import volumes, the United States is still important. So I do think it's in the interest of every country to have good trading relations also with the United States.
If I can, more practical.
Yes, very briefly. Hélène, I've got a question here for you that I want to get at. Will the European payment system have an increased role in trade?
So the European payment system, so what has become apparent as these geopolitical tensions have been rising are the dependencies, right? So we talked about dependencies in terms of rare earth. I talked about in terms of critical minerals for the electrifications. Clearly, China has been minimizing dependencies on the outside world while maximizing exports, but also in finance. So what has been pointed out, and in several speeches of Christine Lagarde and also Phil Lane, the chief economist of the European Central Bank, is that a lot of transactions within Europe depend on American companies. So if you think about a lot of a payment system, between households and also companies, they go through MasterCard, Visa card, PayPal, Google Pay, and others, Apple Pay, all Americans, right? And that means all the data, all the infrastructure is in the hands outside Europeans. And actually, for many countries, even within the euro area, there are no other substitutes which are purely euro-based substitutes. There's a few countries for which you can do a domestic transaction with a domestic company and maybe some cross-border transaction with that payment company. But for some countries, no, you have to go for one of these American-owned companies. Now, you can consider payments is a critical infrastructure, right? And if you think that, and if you want to decrease your vulnerability, then it means you have to develop your own payment system, which is part of what the ECB has been doing, or is currently doing, in terms of introducing a retail CBDC, which is a central bank digital currency. I understand mainly with a view of being a payment system replacing these American companies for the euro area, but also developing a wholesale CBDC with potentially much more integration with financial asset trades, which would be tokenized, with possibly some cross-border linkages. So all that in order to make the payment system in Europe more independent, more resilient, and also to keep up with the technologies. Because one thing, I just alluded to, is that there is a US Treasury initiative to push US dollar stablecoins very heavily outside of, in the whole world, essentially, with the explicit goal, or one of the explicit goals, is to get a lot of these companies to buy US Treasuries. Right? So whether it's good in general, there are obviously plus and cons. If you are in an economy where you have hyperinflation and you are looking for some kind of stable medium of exchange, it might be convenient to have a US dollar stable coin. In the old days, your economy was dollarized. You would use dollars or euros in order to substitute for your currency, because your currency was really not stable. So maybe a US dollar stable coin will be more convenient. So there might be some plus to that. There might be some pluses to that for people who do cross-border remittances. But there are lots of risks, right? Lots of risks. So one risk is has to do with dollarization of economies who don't want to be dollarized. And that's important for monetary policy. Another type of risk is cross-border transactions which go below the radar, as a lot of things in cryptocurrency. So that means illegal transactions which are not vetted for anti-money laundering, which are not vetted for anti-terrorist transactions. So the underworld economy, that's a very big risk. And the erosion of public finances if these instruments are used for tax evasion. I think it's a very, very big risk, on top of the usual financial stability risk that people will point out. If you have a stable coin, it's a bit like a money market fund. You have no lender of last resort. So suddenly there's a run, and if there's a run on the stable coins, there's no so far, no lender of last resort, no liquidity being provided. Good luck if you want to recover your money, Right. Tether, biggest market cap, incorporated in El Salvador.
Absolutely. Let's do one or two audience questions. Anyone? First row.
Thank you very much. Very interesting panel. Actually, I have a question for you, Ms. Ambassador. You mentioned this economic security plan of the European Union. Could you elaborate a little bit? Will that be completely in the framework of the WTO, or how can you enforce independence in the European Union by changing these supply chains, etc., without having an impact then on tariffs and on other trade rules?
Thank you.
Well, very good question. As I said, it's still being internally discussed, so I cannot right now start speaking on details about it. The idea is to use a mixture of instruments. We are already using, for example, trade defense instruments that are legal under the WTO, but we will be devising new other instruments, not necessarily related to trade, but can be investment. That is not regulated by the WTO as such, or for a large part government procurement, which we are also using, but it's for the first time we are devising a conceptual strategy to be discussed after in the Council with EU member states, how to ensure that Europe avoids these vulnerabilities and takes care also of its economic security, not only the military, but the economic security, which is extremely important. So this will be published in the course of next month. Yeah, and it is the first time, it is the first, we have been in discussions, there is, Japan has also adopted a couple, 2 years ago, an economic security strategy. So there are more and more interest around the world to ensure that we avoid the vulnerabilities that we have been facing ourselves right now. If I can just reply,
yes,
one good question that you put, what is the motivation to do agreement with the United States right now? Very simple. Instead of paying 25, you pay 15. Instead of paying 39, I hope Switzerland, and let's not be realistic. Switzerland, and I hope so, makes a deal with the US to reduce out of 39%. Most likely will violate one way or another the WTO.
It's not such a big deal?
Switzerland may be in a good position because your tariffs are already so low, except for agriculture. But they are so low that maybe you don't need to give much. But any country who has made a deal is obliged to violate the WTO. As simple as that. There is no other way.
Maybe final question from me. We don't even know at this point whether these tariffs are legal. The Supreme Court is debating this, and there was a lot of skepticism. So if they're not, and we'll get the ruling in a couple of weeks, I guess, if they're not, will Trump find another way? What's your best assessment, your best guess?
He will find another way, and they will litigate for another 12 years and 5 years, and he just carry on. It's interesting that one of the reasons that he said that the tariffs, the 10% floor, it's to generate revenue to pay in part for these big, beautiful budgets. Now, in front of the Supreme Court, he's saying that the tariffs is not for revenue reasons. So you never understand what's behind that. But he will. Everyone says that he will find other mechanisms, and then there will be more litigation going on, and he will carry on.
Mm-hmm. And didn't he want to give out a tariff dividend to U.S. Americans too, worth $2,000?
Yeah, I read that today. Yeah.
Yes, but I think that's to get the population on his side as we're going into midterms next year, I assume. Ladies and gents, thank you so much for that. I know there's a lot more to discuss, but I want to thank you for your time, for your inputs, your questions. We will take another coffee break, and after this break, we'll talk about how companies are responding to the tariffs. And I think, Hélène, you gave us a great insight into how that could work. Thank you so much. Thank you. Thank you. Ladies and gents, welcome back. I think the last panel discussion set up us nicely for what we're talking about today, and that is how businesses are dealing with the different complications when it comes to global trade, but the turmoil that we see beyond that. Michael Bolliger is here with us. He's Chief Investment Officer for Switzerland and Global Emerging Markets at UBS. Thank you so much for your time. He's in the middle. Paul Bolke, Honorary Chairman of the Board of Directors at Nestlé. Great to have you, for you to grace us with your presence. Thank you so much. And Raoul Segal, he is the CEO, of course, of the Swiss American Chamber of Commerce. Thank you so much for your time as well. So to keep you active, once again, you can put your questions to the speakers, of course, but also we want to do another polling question with you. So let's get out the phone once again, and we'll discuss it on the panel as well. What is the top challenge international firms are facing today? What is the top challenge? And let's show you the result as soon as we have it. Are you voting too, Paul? Yes.
I want to have a voice.
Yes, that's important.
You're such a good Swiss citizen, right?
Regulatory complexity. That one's interesting. Supply chain resilience, geopolitical risk, climate transition. It's quite at the bottom. Regulatory complexity, that seems to... Maybe we'll keep it going for a little bit. But I think one thing is clear, there's an abundance of challenges for international firms, but I just want to connect this to the last panel that we had and talk about the trade environment, because Rahul, you and I, we spoke on August 1st once the tariffs hit, and of course that should have been a day of fireworks and barbecues, but it was not. It was a big shock. Talk to us about maybe your reaction on the day. You were up early, and talk to us about how businesses in Switzerland have fared since.
Yeah, thank you. Firstly, thank you for having me. So I think, like everyone else, we did not expect it, and I think it was a shock to get those 39%, because Switzerland had the rate of 31%, and the goal was to move away from 31, but in the other direction, and we went further up, which was far more than we even anticipated. I also do not think that it was to be expected, since in the phase that led up to that 1st of August, we had, after the 2nd of April, and I refuse to call it Liberation Day, a long period of conversations the Swiss government had and the businesses had with the Trump administration, over 20 rounds of negotiations that led up to some sort of a document beginning July or end of June, beginning July, that looked like something that the UK had and also other countries had negotiated, all respecting, by the way, the WTO rules. And we did not, and then there was kind of one month of standstill where, during which many other countries had concluded trade deals. And I think then it was kind of clear that in that month of July, we need to find some sort of a solution with the US, because, as I mentioned before, the idea was to prevent a snapback to the 31%. And then whatever happened. And your second question was, how are business coping with it? It's interesting what was said on the previous panel, that it's a turmoil, and trade is a little bit under pressure, but not as much as it seems. So in Switzerland, for example, according to SECO, only 10% of the Swiss exports are subject to these additional 39%, which also guides what the government is going to do to support those businesses. Obviously, it is also due to the structure. The tariffs don't cover services. They do not cover pharmaceuticals. They do not cover gold. So a lot of the sectors are excluded. However, for the ones that are part of this 39% additional tariffs, it's very tough, because typically it hits the industrial sector, because they manufacture a lot in Switzerland. They have lost about 10 to 15% in currency. They have lost 39% additional tariffs, and then since Switzerland does not have a free trade agreement with the US, we also have the existing tariffs. So they are somewhere usually between 3 to 10%. So a Swiss company has, since the 2nd of April, additional cost of 50 to 60% compared to a US competitor, which is obviously not sustainable in the long run.
So there was a lot of finger pointing in the days after and a lot of, sort of naming and shaming. And one theory is that, of course, the pharmaceutical sector holds Switzerland hostage. These were the comments from one of the CEOs in the watch export industry. Do you subscribe to that?
No, not at all. I do not think that had an effect on these current negotiations.
But we know that Trump does not like the sky-high drug prices that these companies, Roche and Novartis, are charging in the U.S. So it must be part of his grievance, no?
And on the other hand, there are no tariffs on the pharmaceuticals
Not yet.
right now. As we speak, yeah. We can only talk about what's right now, and there are no tariffs, and I'm not sure whether Swiss pharma companies are ever going to face tariffs, actually, since their level of domestic manufacturing is quite high. Already before Trump came to office, 80 of the two large Swiss pharmaceutical companies, 80% of their manufacturing for the US was done in the US, so we are talking really about the 20% delta that are still required to onshore if one wanted to do that.
Now, of course, you represent the SMEs, the small and medium-sized enterprises, of course. Now, I've got sitting next to me Paul Bolke, who is the honorary chairman of one of the largest consumer groups in the world. So if you're, I don't know, a speedboat, a small boat, you're a tanker. And a tanker doesn't necessarily always, crash when there's a huge wave. Are you immune to the tariffs because of the size of your company and the presence all over the world?
First, it's nice to be here, and we are not a tanker.
What are you?
We are a fleet of many ships. And we have to maintain agility too, but we have a size. And tariffs, the United States, first of all, we produce, in general, 95% of what we sell is produced locally because food has normally short supply chains, local production, local farmers, local consumers. But yeah, it does affect certain parts of our business. Just think about Nespresso. It's produced, at least the coffee is coming in, but it's produced in Switzerland, and the United States became the biggest market we have for Nespresso, which is proof of success, and yet there is the tariffs there, etc. I feel the pharmaceutical products should be cheaper so they have more money to buy our capsules, you see. But, and I know also it's not because of the price here to there, it's the system in the United States that makes them very expensive, but that's another story. So, yeah, when you have tariffs, with a partner like North America doing what they do and imposing some tariffs, it always affects you. Now, we as a company also, we learn to help to frame normality and common sense into the global context we're living in. But when you cannot move that, then you have to accept it and adapt. I mean, and that's what we do. I mean, on capsules, you don't put a factory in there from one day to another either. And you have to see and maintain these things in context. And the context is also the numbers that we see here. It's only that percent. It's only this, only there. And I know that for small companies, these tariffs, it's a little bit, you cannot die in 2 centimeters of water. Depends. When your business is 100% linked with, then you're in trouble. And I think we should see what we do there. But in general, you have to maintain context also in time. I don't believe these tariffs are going to fall all of a sudden after, etc. That's because they get used to it. It's like a drug, as I heard now. But we're going to have a couple of possibilities to adapt to. But I would definitely, on tariffs specifically, but in general, on all the turbulences we have, the crisis we have, we may come there a bit because it's not only tariffs. Don't overreact on the short term. You have to maintain contextual thinking, and that's what we do. So we have a natural hedge as a company, true, and that is linked with different kinds of products and all that. We are local, and yeah, we're going to handle the Nespresso thing.
How are you going to handle the Nespresso thing?
By increasing, they're going to increase the price, so it's going to be more expensive. True. We are also revisiting some parts. Coffee prices are going down, some that may help too. But we're not going to start jumping on this and saying we're going to build a factory here and there, because these are promises, words, and they don't have it in 2 years, 3 years, anyhow. So, but there's many levers that you have to work on. And for us, we don't sell prices, we sell value for the consumer. So we're going to make Clooney work harder.
Clooney, yes. Nice contract there. Michael, Paul talked about many avenues to adapt for companies big and small. What have you seen in the companies that you cover and that you work with in terms of how well they've adapted?
Yeah, I mean, first of all, just to add on the pharma story, right? I mean, I for myself, I decided I don't want to be in the business of predicting what President Trump is doing, right? Based on a sort of, because I can't, right? And sort of like after.
No, nobody can.
Yeah, and so after a while, the great thing about getting older is sort of you start to learn what you can, what you can't, right? And you do the former and you stop the latter, right? And also, I guess on that point, you also don't want to be necessarily in the business of, you know, leading these negotiations and to the finger pointing, right? That's, I guess that was a phone call no one really wanted to do, and someone had to do it, right? But coming back to your question, I think, you know, this took us by surprise, of course, and we went in totally the wrong direction. But since then, I think by and large, it's not as bad as we thought it would be. And we heard, you know, Professor Olsa commenting on that as well. You know, people revising forecasts, and yes, I think the pain will come later. We're seeing, you know, to the coffee prices, we're seeing, you know, U.S. good price inflation picking up, so the tariffs ultimately will, to a significant extent, being passed on ultimately on U.S. consumers. So I think, you know, the business will be fine. But also, I'm always a big fan of going back in history and, you know, looking at previous episodes where we had similar things happening. And of course, we didn't have a tariff shock, but, you know, we had, you know, the Swiss franc adjustment on the euro-Swiss, and there's someone in this room who could comment better on this than I can. But, you know, this was a huge shock, right? And it was a shock that affected everybody, not only goods exporter, but all the Swiss companies. And that, to us, was just very immediately the first point where we started to again go back 2015, you know, studying what happened exactly and how was the pass-through into, you know, stock markets, bond markets, etc. And, you know, with hindsight, yes, it was painful, and specifically it was more painful to the small companies that couldn't really adjust, that don't have the flexibility, but ultimately, you know, Switzerland managed. I mean, I always say, we should not underappreciate or underestimate the ability of people to adjust specifically in crisis. That's what I think human beings are really, really good at. And so I think from now, what we see in this specific thing, as it evolves, I'd say overall significantly better than I expected 1st of August.
Let's hear some specifics here of companies that you're working with in terms of how they've dealt. Have the majority of them, have they been able to raise prices? I spoke to one chocolate producer, a very small one, don't worry, but he said that I can't raise prices any further. No one's going to buy it. There's a limit, obviously, given that the consumer is very price conscious anyways in this environment. Others are finding loopholes in the sense that maybe they lower the goods price, but they increase the services price of their product. What are some of the loopholes? What are some of the tools that companies are using?
I'll just get into that. I just want to say something on those 10% and the adjusting to the new environment. What I think is critical here, what's happening is that you have the majority of the economy that is not touched by these additional 39%. However, the ones that are affected, they have been suffering for the last about 7 to 10 years mainly because the European Union and number one being Germany has been flat. So if you look at the German growth, it has been flat over the last 7 years, and earlier for 70 years till 2021, Germany used to be the largest export market for Swiss products. Now it's the US as a single market. However, still 47% roughly of Swiss exports go to the EU. And Switzerland is one of the few industrialized countries that is actually still industrialized, meaning thereby that 20 to 25% of GDP comes from the industrial sector. If you look at the US or the UK, you're somewhere down to 10%. So my largest fear in this current constellation, Frank shock and all these other, and COVID and all comparisons aside, is that if it stays this way, we are going to also slowly but surely start deindustrializing and becoming one of these, I hate to say the word, but average industrialized nations that mainly does services and has actually no specialty, because one of the strengths of the Swiss economy is also that a lot of sectors that we have were developed over time. If you take, we talked about pharmaceuticals. So at that time, at some point, they were making textiles in St. Gallen, and then they started to put paint on them or colors, and that created the chemical industry further down the Rhine, or also the watchmaking and the med tech. And also, I have a fear that we're going to lose all of that if it remains this way. Coming to your specific questions, I have three categories in my head of our member companies. Roughly one are the big ones, like Nestle, but also others. They are local for local, more or less. And they are also, they care more about, let's say, copper tariffs than about these 39%. Then you have kind of the mid-range, and they usually have multiple supply chain or multiple sources. So they could say, oh, currently I'm going to now send it from Poland or from Germany or even from another country to the US. It costs money, but it's possible. The worst hit are the small ones that actually manufacture in Switzerland and that don't have any other way to go. And some of them, they created stocks, large stocks, because between the 1st of August and the 9th of August, when the tariffs came into effect, for example, we have some watch companies, everyone in the executive board went to the US with 2 suitcases of watches, and actually...
But legally?
Totally, everything it was legal because you paid tariffs, but you paid 10% and not 39%. Others have other ways to go about, like that you source from a different country, that you sell it at what is called cost plus in transfer pricing, that you actually do not take the sales price in the US, but you take actually the customs value, which is much lower, and you have 40% or 39% on the customs value. So there are many ways how to handle, but many cannot, and for many it is not exactly what they want because it doesn't suit the business model actually.
Mm-hmm. Innovation was mentioned by Hélène in her input speech earlier on. Innovation and rewiring of supply chains. How's that happening at Nestle?
Well, first of all, I mentioned before that we have this hedge of locally. That's true, but yet at the same time, you have to re-engineer your supply chains a bit, and I speak in general now, because with these tariffs and the trade, although relatively, we were working towards worldwide the most cost-efficient supply chains you could have. I think we're going to have to rewire. It's not going to be the most cost-efficient anymore, but you have to de-risk. Now, de-risk, what does it mean? It means that, for example, if we have a small ingredient of something somewhere that we use worldwide and one supplier, that's not going to work anymore. So we're going to have to look for alternative suppliers. And that's basically making your supply chain, although we are quite local, more robust, and also agility. And that's where then also the AI can come in. If you think the 100,000 SKUs we have and all the formulas and all the ingredients we have, to know the alternatives, how you can rewire, re-engineer even your formula, etc. All these things are going to come into play. And so these are the things that we are accelerating now because of not only USA, we do see a certain dimension of separation and the polarization of things, although I do believe also you cannot defy gravity. Globalization is coming. Think about data, information. Globalization is not only physical, but so I do believe that's going to continue, but it actually creates also, even if the borders are open, it gives you resilience in your supply chain, and that's very important. That's what we're working on in an accelerated way now.
Mm-hmm. Michael, you have a pretty good grasp of how international investors are feeling, wealthy investors, of course, some of the biggest family offices in the world. And you could argue, if you take a look at the equity markets, asset prices overall, and we heard from Mr. Rajan before that, everything looks pretty frothy right now. No one seems to be seeing any real problem. In terms of the sort of bifurcation that we're seeing, though, equity prices, record highs, gold prices also recently at record highs.
Yes. Swiss franc.
And the Swiss franc, of course, as a safe haven, that's quite a contrast. So what really is going on here?
Yeah, you're getting, from different assets, you're getting different messages about what's going on the planet. But perhaps just quickly, I think the questions we had before and the answers that were chosen, it just shows you also that, the focus, us, the media, the discussions we're having, even in this panel, it's very much also guided by, select media, select people sort of setting the agenda. And often, we tend to then miss bigger, more relevant issues. And I think Paul made some very interesting comments in that regard just now about AI and how AI can potentially, not today and tomorrow. This is not, hey guys, here is Copilot, do something great with it, right? That's not how it works. But if you fast forward 2-3 years, it's well possible that, the average productivity on, say, a service company will be somewhat higher than it is today, which can have a huge implication on how we think about EPS growth and costs and P&L revenues of that company. And so, financial markets, sometimes right, sometimes wrong, ultimately want to make a business by trying to anticipate some of these developments. And so what you're seeing there is a huge, I call it euphoria, and I think it's very, very clear that not all of that money will be well invested. That can help to explain that the equity markets are doing well, that specifically also the US is doing well with all these great tech companies, that Europe perhaps is having a more difficult time. That China specifically is catching up, but at the same time, you look at gold prices, you look at the Swiss franc. The message there is very clear. Something is out of balance. It's around debt sustainability. This is for me one of the big questions. How are we going to resolve these giant burdens of debt? The reason President Trump introduced his tariffs is not only to hurt the small Swiss companies and the watchmakers and the pharmaceuticals. It's ultimately about finding ways to tap into revenues that don't have to be paid by the people voting for him.
Mm-hmm. Absolutely. I want to come back to innovation, though. Again, something that Ellen mentioned, something that Paul alluded to. Switzerland is always seen as the world champion of innovation. Can the Swiss companies that you work with, can they innovate their way out of this crisis, the relative crisis that we're in?
I agree that Swiss companies are very strong in innovation, and I think that they are all very aware of the fact that without being the best at what they're doing, they will not be able to succeed, because in Switzerland, per definition, we have higher prices. And I think that's one of the reasons why many can even sustain in this market environment, because they have, for example, products there. You asked before strategies; those are not only strategies, because they are, for example, built in a different product. If you have a motor that's built in an airbag, or a sensor that's built in an airbag, it's going to take a while till a car manufacturer in the US says, "Oh, I'm going to try to find another supplier because it's maybe 82 cents cheaper." So that's because they make top products, and most of them spend an enormous amount of their revenue on innovation because they know they will not be able to succeed without that. So it's in the DNA of most of these companies.
Mm-hmm. Paul?
If you allow me, I tip my hat for Switzerland. Because if you think the Swiss franc, we speak about tariffs in one country, but the Swiss franc is for all countries. And if you think in the last 15 years, the Swiss franc versus the euro, you may be wrong, Thomas, if you correct me, but that maybe 1 euro was something like 1.65 or something, Swiss franc. And now it's not even one or just. And the exports went up. And that's the mindset too of the entrepreneurs in general, but also everybody who is part of the economical system, which is don't claim a future, work for one, and adapt. And we had politicians that let that go too. So we have to also send a message to the politicians to let that happen, and create the environment that is moving forward. The other part is innovation, renovation. We have actually an ideal time now to get some researchers and developers from the United States coming here, because with some problems they have there. But these are opportunities. That's the realpolitik, you know.
I don't know if you saw the announcement by the University of Zurich, 2 top research comments. So it's happening. It's happening. Yes.
That's right. Switzerland works. I mean, they do things, but think about it. And you mentioned that. I think for a country, industrialization, having factories, is extremely important. And Europe and other countries, they had let that go a bit because they felt that was from, and actually the globalization allowed you to do salaries very cheaper and all that stuff. Switzerland always embraced manufacturing and all that still, and that is also with the apprenticeships and all that. It's all linked. So we should be aware of that, and I think Switzerland should be very much explicitly aware of why are we where we are, and don't play around with that. And the world of today is challenging that even more, and giving all reasons of starting to claim a future instead of working one. Actually, if you think, and Europe is a little bit in that trap, because Europe at the end of, not Europe alone, I would say the West, is actually drunk on welfare and peace, and is blind on crisis and blind on reality, and they don't adapt, and the social system is so locked in, and they claim people, and you cannot break that ice. I don't have to mention any country that is a good example of that, but it's a country not too far from here where they speak French. If you see...
And it's not Belgium, right?
And Belgium, for that matter, is not much better, but it's a pity because the population doesn't connect anymore with the reality somewhere. That's why I'm saying they'll drink on peace and welfare. And peace, they see peace as a sign of performance. It's not. It is a result of many things, but the many things you have to do first. It's not a given. Yeah. So, and these mindsets, you see, I'm retired now, I can be philosopher, you see, but
I quite enjoy this.
But somewhere we have to reconnect the population and the broader base of countries towards these realities, and then say, let's shape it together. For that, we have to sacrifice sometimes, because at the end of the day, the debt we have is to have a luxury life now on the base of our children. And so inflation is, but I feel inflation is always the last legal means for authorities to reduce their debt. At the end of the day, that's what they do, and so we're going to have some inflation coming.
Okay, so how do we apply this to Switzerland? Again, innovation is key, diversification is key in a crisis, and we can't hide behind a state. What does Switzerland do to remain competitive?
I mean, just on the question before, when you ask, Raoul, he said, like, can Switzerland innovate itself out of this crisis? And this crisis, I assume you refer to the tariffs, right?
Yes.
But this crisis, to me, can also mean what we just heard Paul talking about, right? The fact that what you mentioned, Germany in real terms didn't grow for the last decade. No one has mentioned China and the threat, technological competition, manufacturing competition coming out of China, what that means to Swiss European manufacturers, to the German and French car industry. And so I think these things, from what I look at this from a financial perspective, I would agree with Paul. I'm afraid Switzerland at this point is relatively little it can do, right? Because when I listen to the news flow out of Paris, the things happening there, and I'm not referring to the Louvre, right? I mean, it needs to get worse, I think, before it gets better, right? We need to see more pressure on these 10, 15, 30-year French sovereign bonds before the political elite in this country decides that we have to bite the bullet and we have to do something that politically is very costly, is very unpopular. It's interesting to follow that conversation right now in the UK. They seem to be one or half a step further ahead in that journey. Maybe there's a somewhat greater willingness to tackle some of these things. But before this happens, before I think specifically Europe wakes up to, this changing, international landscape for international competition. I think the best thing Switzerland can do is sort of to try as hard as it can to be independent, to innovate, to make sure that it finds ways to cooperate and trade and collaborate with as many countries out there as possible.
I'm seeing a lot of audience questions come in, so let me get to those. Should Switzerland still strive for a Swiss-American free trade agreement, possibly with a post-Trump administration? Didn't the People Party think that they could strike it with the Trump administration? But I guess that's very far off.
Yeah, I think the word free trade agreement is not appropriate anymore. And not because of the free, but a free trade agreement really abides to WTO rules. It's got a set of issues it needs to address, and so on and so on. So I think one needs to talk about a trade agreement, and a trade agreement is still something that Switzerland and we also strive for at this point in time. And I do not think it's unrealistic, but also do not know if it will happen or not. So I think it's an important thing. I also know that in the Trump era during President Biden's administration, there was zero appetite to even discuss trade deals with us or with any other country. So I think now could be an interesting a moment. To what was said before, I think innovation is a good thing. Diversification, free trade agreements was mentioned before. Switzerland also does. We also just did Mercosur, India, However, I think a big point that came out in your survey is also what can the government do to enable all of these kind of things. And there, I think we are not doing a very good job currently in regulating businesses, adding costs to labor, which goes into the point that also Paul mentioned with welfare. Welfare is kind of the fruit you get for having worked. If you look at Swiss numbers in the 60s, about 33% of the Swiss budget was used for defense and about 10 for social welfare, and now it's like 35 for welfare and about 5% for defense. And I think, again, something which was again mentioned before, I think we need to completely rethink all of this. I do not think that in 10 years we'll be spending, especially in this country, so little on defense, for example, or on resilience in terms of energy. And all of this needs also government investments, government money, and that's all tax money, and one needs to then make some hard choices.
Defense is going to increase in Switzerland because they buy some planes. Remember that.
Sorry, what's increasing in Switzerland?
The defense expenses are going to, because they buy some planes.
Right, but I mean, at the moment we have no defense. We have zero air defense, just nothing.
I hear that the budget is quite strained from the government side.
But that's exactly what I meant with the priorities.
Right.
I think, and that's what also was alluded to. It's a question of what you spend your money on. It's not, do I get more money? So then what do I spend the money I have on?
Well, in Germany, there was only one way of doing this, and that was relaxing or refiguring the debt brake to find an exception to this.
But that's a dangerous thing. You see,
why
that's again,
that?
they tip my hat for Switzerland, they're disciplined. Budget, imbalance. I mean, but these are things that are not a given. If you see the other countries going with 6%, 7% deficit and all, it's you have to hick it up. You have to maintain the discipline and know the whole atmosphere now, the whole environment is like, okay, but give yourself a break because these are difficult times. We always think that the crisis of today is the worst crisis ever had. It's not true.
You've seen a fair share of crises.
I've seen a few, but everybody. Look, but we have a selective memory, you see, and we think now that's the worst of time. I must say it's a little bit messy lately. And there is something we don't talk about. There's a war going on. And that's an unpredictable event that is life-threatening, I must say. And that's why we start to give ourselves a break. Let's build up welfare. Let's calm people down, etc. So I think the biggest challenge we have in our society is in the north, in the west, northwest, is basically reconnect our global people, the base, with reality, and maintain the importance of economics and the economic and entrepreneurship and all that is important. It's the engine of our society. It is what allows to have the welfare. And that is dislinked. We have more and more politicians that don't have a clue of reality. Think about, I should not say it's public, but anyhow, you have 750 parliamentarians in Strasbourg. How can Europe be in a world that is getting faster and faster and faster? How can you actually link up democratic decision-taking with that fast-moving world when you have other countries do have another system that goes faster? You see, I think also all what we perceive here in the West as, oh, crisis, 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 many countries are just happy. They say, let's tear the West themselves apart, because that gives us opportunity of playing, of being, of going forward.
So let's, sorry to interrupt your philosophical musings here, but let's, with all due respect, you mentioned a very good point, and that's why I want to jump in here. Other countries who are watching this, and let's take China, for example. How do we deal with China? Of course, it used to be such a great export market. Now we're at the risk of being the receiver of overcapacity. How do Swiss businesses deal with China, friend or foe?
I think for many companies it's both. So you work in China and you have a market in China and you sell, or you have an entity in China and you have the same thing in the US or in other places. I think for big companies you have a little bit the system that you have kind of China for China, the US for the US. That's slowly happening now during this Trump administration, and sometimes you have a kind of Switzerland for the rest of the world. I mean, how should we deal with China? According to me, China is the only other nation that is technologically advancing apart from the US. So I don't think there is a big question of whether a country like Switzerland can in any way remain insulate itself from China. So I think we need to deal with China. What we need to do as Switzerland, I think, is to make sure that we do not get squeezed in some way in the middle, but that is for many countries. Right. If you take some Asian countries like Malaysia, for example, they are even more exposed to this kind of, they just concluded a trade deal with the US, but on the other hand, they have kind of China in there all around them, basically. So I think that is going to be one of the big discussions in the near future. But you know, the US also concluded a trade deal with China, so why shouldn't other countries do the same thing? It gets riskier when you talk about export controls, investment screening, sanctions, and so on.
Yes, there's a question on China here. China's role in global innovation is fast increasing. Should we not start to look for R&D cooperations more than to trade alone? Any views on this?
Yes.
I'll take it.
Because yeah, but China, should you work with China? China is there, it's big.
Exactly.
I mean, so you have to do it as long as you can live up to your values, basically, and all. And I must say, each time you go to China, we speak about our environment and all that. Well, I must say they're very serious about that, because it's they know it's life-threatening for them. So the innovation, definitely, and I know it's but the intellectual property and all, these are issues. But if you want to have a clean thing, to start playing fully and security of everything and all that, you're not going to take risk. It's difficult to be there, but stupid not to be there.
Mm-hmm. You have a pretty big market there, which was somewhat weaker, though, when you take a look at the past couple quarters. I know you've got a new management in place, which is tackling everything head on. What's your message?
I'm retired of Nestle now, so I don't talk. But
you're still the honorary chairman,
yeah.
and
you
know Philip very well, obviously.
I'm confident. Well, it's a nice 1.4 billion people. It's a big country. Nutrition is an important part of the equation, so we're part of that. So looking forward to good years to come. Another country that we don't talk too much, India. India is still small. We have mentioned it.
Yes.
But that's a very interesting country where somebody is working silently, framing it in a good way. It's going to be slow, steady. But there are 1.5 billion people, and going forward with 5, 6, 7, 8% growth, not bad on a smaller base. But you have other countries coming. Think about Nigeria. Nigeria in a few years' time is going to be over 1 billion people. Think about that. So that's a reality that I feel we should start also see as, in other words, we spoke about supply chain, trade partners.
Right.
Well, level up. There are many parts of the world where we can have good relationships with.
Michael, and this is sort of switching gears here, but I guess you talked to your clients about this all the time. Can the rearmament of Europe be the way out of its economic anemia?
No.
No, okay.
I mean,
That's the hope.
I'm not, there's a lot of PhD economists here in this room. They can explain that better than I can. But I mean, essentially, the way I think about this is that the fiscal multiplier on buying a tank or building a tank is as low as it possibly can be, right? I mean, you mentioned Nigeria. If you build a bridge from A to B near Lagos, you can involve, you can foster trade, etc. There's a lot of, revenues, multipliers you get from that investment. On defense investments, I think, you hire a few people, you let them run a few maneuvers, but essentially that's not going to lift real economic growth in Germany in a meaningful manner. I do agree with Raoul. I mean, there's going to be difficult decisions to be made by governments, left, right, center, including Switzerland. The planes you mentioned, that, by the way, come without weapons, I understand. And so these are tough decisions, right? And that brings us back to the notion that you also mentioned, that fiscal discipline is of great value. I mean, the fact that in this country we have the lowest interest rates on the planet, that also helps the Swiss companies to be competitive internationally, because our cost of capital is so much lower than anywhere else, right? And so once you give this away, you start breaking up these rules, like the debt brake in Germany. You do one step, and tomorrow is the next, and then comes the next, and then your advantage is gone. So I do think we're very well advised, as painful as it might be right now, to stick to these sort of old-fashioned rules and discipline, because they served us, I think, economically, they served us really, really well for a long, long time. And let's not forget, to make the last point, as I said before, right now, we sit into this, we read the media, we watch the news, and it's all about this trade story. But who knows, in a year or two, this might be a bit on the back burner. We'll have other issues, of course, as well, right? But I'm always a bit cautious when people sort of argue, let's do everything differently right now, because the world has become so much different. Usually it doesn't.
Raoul, one follow-up question here on the rearmament in Europe. Is Switzerland, for various different reasons, going to miss out on that boom in rearmament? Can that be a way out of this current mess that Switzerland is in from the tariff front?
I wouldn't connect those 2 points a lot, because I don't think the tariff thing has got so much to do with rearmament. However, I don't think that we will miss out in any way. I think it is our obligation that we do not miss out. Switzerland has one of the lowest defense spendings. And okay, Switzerland is a neutral country, but we are at 0.7%. If you add maybe the militia system, then it's a bit more. However, of GDP is defense spending. I do not think that we'll be able to do that in the long run, because we will need to be able to defend ourselves. So it's not I don't think it's even a choice. With regard to the benefits of defense spending, I do think that there has been a lot of, if you look at the internet, but there are also other areas, the tanks, if you look at Germany, car industry, also Japan, similar. I do think that there are benefits in defense spending. I do think that there is a lot of innovation that can be created through defense spending. In the US, you have an interesting phase of robotics, AI and defense that's coming together. Some of you know they are all kind of drone companies, they are AI companies that work exactly in that sphere, and they are doing extremely well. And I think they help, on one hand, the US government to advance, but they also help the technology to advance to the extent that some of those companies have governmental clients and at the same time commercial clients for a similar use. So I do think defense spending can be very beneficial, especially R&D in defense in a country like Switzerland.
Let's take some questions from the audience here. Anyone with a question here? There's one on the left. There's one here as well.
Thank you. I believe your climate risk being very low is maybe a gender bias of the audience. But my question is, it was touched at the very opening remarks that global trade is good. However, sometimes the gains are not shared. And there's one group that is benefiting, and maybe some groups are not benefiting. And today, and right now, it was mentioned that Trump, the reason for raising tariffs is also to create a certain source of income to be able to pay his base. So my question is the neoliberal trade system failing, especially when we see so much populist politics coming out from the left and the right? Some people compared Mandani's campaign in New York similar to Trump, for example. Do we see that because we're failing to address certain inequalities in the world?
I would say yes.
Yes.
May I?
Yeah.
Yes. To a certain extent, the global open trade and globalization of trade, etc., has benefited more the North than the South, and that's why you have also the South it's quite messy there too, and so I think we have to find systems where we actually start investing more in these countries. I do believe, also like North America, we should go. They should take care of Latin America. It's their backyard. It's youth. They have immigration anyhow. They're coming. You better start investing in your backyard. Same for Europe. I think Europe should play also more with Africa. We have some mental blockage because of the colonial times still, but we should go there. Actually, Nestle as such is only doing that as short supply chains. We invest in these countries. We are present and have our people and factories, etc. So I feel we should do more of that, and that would allow to have more stability. That would allow also to have, because the immigration somewhere to a certain extent have less reasons to have it, because that's a big burden coming to us, and we don't have an answer yet to this over time. You think we need manpower, aging population in Europe and all that. It's true, but think about in my area there agriculture and so political stability. And I was a few days ago still in Latin America, and if you think. It's quite messy. If you country by country and all, if you think it through, it's a continent of the permanent future, but it's not coming because basically there's no North interest in stabilizing these countries from within. You see, so you have a good point. Environment, very strange. Have you seen? It was very low on the agenda all of a sudden. This is in 2 or 3 years' time. All of a sudden, flipped, and. I think the most serious dimensions on the environment are the companies. More than the politicians, because they change. Green Deal, it's no deal all of a sudden, or something. And the supply chain thing and all that, we're going to put it on the back burner. And we in Switzerland, we already decided it has to be like this, like Europe wants to have it. So we have that now coming to us. And the Europe say, we're going to wait. So that's a little bit the problem we have in our to lead a company. The biggest challenge I always say, is not the famous VUCA volatility always had, the uncertainty, complexity. It's the ambiguity of things. What was right yesterday is not right anymore, but it's not wrong either. What was good yesterday is not good anymore, but it's not bad either. How do you manage a company like this? I mean, and that's a little bit the thing. There is not one truth anymore. We had convergence of references through the international institutions, but also on how we see the world. This has changed. I think that's the biggest challenge that actually all leadership in our world has. There is not one way of seeing the same reality. There are values, there are basic ways of philosophies, of seeing things, and I think we have to learn to cope with that and have judgment capacity. There's too many intelligent people that we lack judgment capacity, wise people. There's lack of wise people.
Paul, let me try again. Does the new CEO of your company have all these skills?
He has it all. I know him from a long time.
I just want to quickly add on the, if I understood correctly, the gender bias here on the stage. Excuse me? Generation. Oh, I'm still 25. Come on. No, but the point, I just want to be very clear on this. I think what I try to say is that there's a lot of risks out there, but I'm as an economist and as an investor, I'm worried more about some of the things that were not on that list. Like what you say, for me, income and income inequality, actually, if you think through it, the WEF is doing some great work on that. There's an annual publication which is called, I think, the Global Risk Monitor or something like this.
Yes.
It's beautiful how it shows the interconnection between these risks. If you look at that study, it's showing that income inequality, health and wealth, which is something we just barely touched on, right? It's another huge topic, right? That people just getting poorer and less healthy. Disinformation is a huge topic. Censorship. All these things, they're currently very much on the back burner because someone in the US who's currently renovating his house is deciding to have another agenda, right? And that's what I think is super, super important.
Rahul, before we wrap this up, I have two very important questions for you. Can Swiss companies get through this crisis without closer association with the EU, or is that absolutely critical?
I think there's a disconnect in timing. So this closer association with the EU in Switzerland, we are going to probably vote in 2027. By then, either we have these 39% and they'll be there and absorbed, or we will not have them. So I'm not sure. The second thing, maybe because there have been many hits against the person sitting in the White House, I do want to say one or two things that I think an issue is the way he addresses many of these topics, although in many areas I think the what is not necessarily wrong, it's the how. And since we did talk about this whole disconnect between the population, one of the reasons, and one can completely defer and be of a different opinion, one of the reasons why Brexit happened and one of the reasons why also Donald Trump was elected with a sweeping majority, he won all the swing states, he won both the chambers, was because there seemed to be many people that seem to have been missing out on this globalization. Basically exactly what the other two said. And now, will he solve it or not? I do not know, but he did at least address the problem, and he's trying to do something, because one of the reasons for these tariffs is also to bring jobs and investments to the US, and not just anywhere, not to the coast, but mainly into this, what is called Midland or Rust Belt or flyover states. So he's basically also addressing that, and many other topics, also with the tariffs. Just to illustrate that, if you are from the EU or from other economic blocs, the US had an average tariff rate of about 3.3%, and on agriculture 5.1%. In Switzerland, we have industrial tariffs, we are good, but otherwise we are far away. So a car from the US that came into Europe had 10% tariffs, and a car coming from the EU into the US, 2.5. So why should it be 4 times more now? I do completely agree that the word reciprocity is not exactly now met with what he's currently doing. However, I do think that there are many areas like the defense spending, and that was also said on the panel before, that Europe outsourced its defense to the US. So all these points are being addressed. So with whatever is happening, and again, I do not subscribe to many ways that is happening, but I do think quite a few things that Trump is doing have something to do with what the population and the people want, and might lead at the end to a better result globally.
Is that just wishful thinking, or are we seeing first signs?
No, I have no idea, but I do think that, for example, rearmament of Europe makes a lot of sense.
In the media, we saw reports, photographs of Team Switzerland, some of the biggest business leaders of Switzerland. Paul, you weren't there, but others were in the White House trying to hammer out a deal. What do you know? What can you tell us? A better deal.
So, I will not tell you a lot. The only thing I can tell you is that you saw what happened, and then Guy Parmelin spoke to Jamieson Greer, and now let's see what happens.
Paul, do you know anything?
I don't know anything.
I'm still on this generation thing.
I see. So the hope is
Very interesting, though.
the hope is that, Raul, hopefully by Davos, World Economic Forum in January, we might get a deal. Is that the hope? Is that the expectation? A better deal?
No,
Maybe 15% like the EU? Would that be a good deal?
Right. I think the expectation, I think the hope would be at Davos or even before Davos, preferably, because most companies, they cannot wait till Davos.
15%, is that what you're hearing?
I guess below that it's going to be tough. Liechtenstein, with which we have a customs union, a Zollunion, they are also at 15%, which causes a lot of complication, actually. So I think if let's see.
Final point?
One thing that we have to put in front of us is that all what we talk here is not linked with one person. It was actually all happening many years before. The destructuring of countries, the populism, the unsatisfactory, the debt crisis, all that actually was in the making. The not inclusion, the disequalities, the developing countries that were still developing and trying to immigration. So in other words, watch out that we don't put the ticket on one person as the cause of, etc., etc. It's not true. He makes it a little bit more visible, and so we have to see the deeper root causes of things, and it is business, it is societal. And somewhere there's leadership in general, also politicians definitely, but also leadership in general. I think we have to start framing for the population the broader issues, because if not, we're going to go straight against the wall. And it's a pity that you mentioned it has to get worse before it gets better. How stupid can we be? I mean, and it's a pity, because at the end of the day, if we would frame it right, we would start on a journey that corrects a little bit the past and start building. And I think it's linked with education and mindsets.
Wise words from Paul Boeke. Thank you so much for your inputs as well. Really appreciate it. And we're hoping for a better trade deal very soon. Thank you so much. Thank you. We now invite you to an Apéro just outside at 17:30. We will continue with the Zurich lecture. Thank you. Ladies and gents, welcome back. Now onto the final stretch, but definitely one of the highlights today. Before we get to the Zurich Lecture of Economics and Society, a final polling question for you. So one last time, please get out your phones. And this is a question that we already debated on earlier today. Will the US dollar remain the world's dominant reserve currency in 20 years? Yes, no, or weaker than today? I'm curious what you say. And let's show the results once we have it, please. Will the US dollar remain the world's dominant reserve currency? So I assume this is a scale from 0 to 10. I believe 5.7, I would say, very much in the middle. Very much 5.7. The question is, what is the alternative, right? And this is something that we will debate again. Our next speaker surely has a view on that. We are so honored to have him here. His name stands out in academia and beyond. Barry Eichengreen is the George and Helen Pardee Chair, Distinguished Professor of Economics and Political Science at the University of California at Berkeley. He's one of the world's leading experts on global monetary systems, financial crises, and economic history, of course. His research spans exchange rates, capital flows, the evolution of international institutions such as the IMF. Of course, he's also an author of many, many books, widely cited books at that, including Hall of Mirrors, The Great Depression, The Great Recession, and the Uses and Misuses of History, and the most recently published book, In Defense of Public Debt. Mr. Eichengreen, it's an honor to have you here. Welcome to Zurich.
Thank you very much. It's a pleasure to have been asked to give the Zurich lecture. I can't help but note the timing or the placement of the lecture at the end of the day. So many of the things that I intend to talk about have been spoken about already. That will not stop me. It does inhibit my ability to be original. It enables my ability to be brief, and I will try to do that. I notice also that the wine was passed around prior to the lecture rather than after. So I think people were anticipating a dismal economist and needed their mood lightened, and I will not disappoint. So the title of the talk is The Future of Money in a Divided World. The day has been spent clearly talking about our divided world. I've heard a little bit of discussion and can infer that you've had more discussion of deglobalization, decoupling, and so forth. I think it's clear that the coupling between the United States and China is loosening. U.S. imports from China have been falling quite noticeably. I'm having trouble seeing my own small print here, down by 27% over the most recent 12 months through September, and the same is true to a somewhat more limited extent in the other direction, that China's imports from the United States have been falling as well. So these observations are consistent with the more general phenomenon that we call friendshoring, that in the period, say, leading up to 2017, geopolitical distance between countries had actually been, countries are now importing less from others that are geopolitically distant. So you can see that here in the comparison with the earlier period, 2013 through 2017, and the more recent period, 2017 through 2018. 2023 that imports from geopolitically distant countries have been falling, both in the case of the United States and China. It's conventional for political economists to measure geopolitical distance by the alignment of votes with here either the US or China in the United Nations General Assembly. So that's what is being done in this figure, notwithstanding my reservations and other people's reservations about how meaningful that measure is. And you can see the same kind of phenomenon, at least for the United States, not only for friendshoring, but also for nearshoring. So in this figure, I show you average physical distance of source country of imports by value for both the US and China. You can see how the United States is importing more from countries that are relatively nearby. And interestingly, how the same has not been true for China, which is trading more with Africa, trading more with Latin America, trading more with extra Asian sources. So there is some evidence then of decoupling, of nearshoring, of friendshoring, and you can see evidence of the same kind of fragmentation on the financial side. So here I show you foreign direct investment, Chinese FDI in the United States at the top, and US FDI in China on the bottom. There seems to be, if you will, a collapse in two stages where bilateral FDI began to fall during the first Trump administration, and that fall then redoubled, accelerated, if you will, again around 2022 with the heightened geopolitical tensions between the two countries, new US review procedures on Chinese investments in the United States. So these numbers on bilateral FDI are now pretty close to zero. It seems to have more or less disappeared. More generally, we know, courtesy of International Monetary Fund research and other research, that political tensions are a powerful driver of financial flows, not only of foreign direct investment, but of portfolio investment flows as well. So the IMF's research from a couple of years back suggests that a one standard deviation in geopolitical disagreement between two countries, again measured by disagreement in United Nations General Assembly voting, as happened between the US and China after 2015, reduces bilateral financial flows by about 15%, and that's true of portfolio flows as well as direct foreign investment. So these are signs of fragmentation or decoupling between the US and China, both on the trade side and on the investment, foreign direct investment, and portfolio investment sides. So that brings me to my topic, which is the implications for the dollar and the international monetary and financial system more generally. The dollar, as we've heard, and as the poll question just reminded you, is the currency of the United States, but also the world. And it's important in order to gain a perspective on the poll question that was just asked, to remember the extent to which this is true, the extent to which other countries use dollars not only in their trade with the United States, but in addition amongst themselves, that a majority of global exports and imports are both invoiced and settled in US dollars, that the dollar is the dominant currency in international banking, that the lion's share of international and foreign bank loans and deposits are denominated in US dollars. The dollar is on one side of fully 90% of foreign exchange transactions worldwide. More than half of the foreign exchange reserves of central banks and governments around the world are held in dollar-denominated securities and deposits. This disproportion, if you will, between the size of the US economy, which is considerable, and the global footprint of the dollar, which is even more considerable, is, I think, fairly straightforward to understand. It's rooted in history that the United States was the dominant economic power and trading power coming out of World War II. It was the only country with deep and liquid financial markets open to the rest of the world. So the dollar was, we talk now about whether there is an alternative to the dollar, and there may be or may not be, depending on to what extent other currencies aspire to substitute. But there's no question about the fact that there was no alternative 50 or 75 years ago, and history casts a long shadow that once people get used to using dollars in cross-border transactions, they continue. Once their counterparties, their trading and financial partners use dollars, it becomes more difficult and costly for any one player to shift to an alternative currency. So the dollar's dominance reflects the fact that the US is the single largest economy in the world, depending on how you measure things, certainly at current prices and exchange rates, that the market in US Treasury bonds remains the single largest and most liquid financial market in the world, and then there is that long shadow of history, the fact that the dollar's dominance feeds on itself. So this situation confers considerable advantages, in my view, and it will become obvious, if not in the talk and the Q&A, that my view is not universally shared in, for example, the White House. My view is that the dollar status does confer considerable advantages on the United States, that US banks and firms enjoy the convenience value of being able to do cross-border transactions in their own native currency without having to hedge by financial hedges against currency risk. The US government is able to borrow at lower interest rates than otherwise by virtue of this additional demand out there for safe and liquid foreign exchange reserves denominated in greenbacks. The US enjoys automatic insurance, or at least did up until April 2nd, such that when a bad thing happened to the global economy, the dollar would strengthen. Money would flood into the dollar and US financial markets rather than fleeing them. So when a bad thing happened, even when we in the US caused the bad thing, like Lehman Brothers in 2008, the dollar strengthened in an example of that automatic insurance. And the fact that the rest of the world relies so heavily on dollars means that US financial sanctions are more effective than they would be otherwise. So we can debate about whether the precise way in which the United States has employed its financial weapon has been wise or not. But there's no question that that financial weapon is more powerful as a result of the dollar's global dominance than it would be otherwise. So I would argue this is a happy situation for the United States. It's not so happy for all of the countries that are on the other side of this relationship, and that observation is not new. That's the famous observation of Richard Nixon's Treasury Secretary John Connally, shown you here in the fateful year of 1971, when he notoriously observed that the dollar is our currency but your problem. So this situation has been around for a long time. 1971 is more than half a century ago, and these complaints, as everyone in the room will know, go back even further than John Connally's statement. They go back to Valéry Giscard d'Estaing, they go back to Jacques Rueff, they go back to John Maynard Keynes. What is potentially different is that, unlike the situation after World War II, or even unlike the situation in 1971, there now exist potential alternatives to the dollar. So one widely mooted possibility is China's currency, the renminbi. Another is a network of digital currencies issued by emerging market central banks and traded on a single blockchain or traded on a dedicated platform where they can be directly exchanged for one another without having to go through the dollar and the US correspondent banking system. And since I'm on this continent, there is also the euro, and I will have one very brief slide that has 2 or 3 bullet points about the euro when I get there. Those are the potential hypothetical alternatives. The important point is that actual and hypothetical are not the same. So we heard earlier how China's financial markets are not fully open to the rest of the world. And I would layer on top of that the additional observation that Western governments and central banks are reluctant to rely on the currency of a geopolitical rival, and that private investors may be reluctant to trust the currency of an unchecked authoritarian government. So I've long argued that one of the strengths of the dollar is that the United States is a country of rule of law and checks and balances and division of powers, and that gives it a leg up in currency competition over China. Well, maybe now the tables are more balanced, even if they haven't quite turned. So there are questions about the renminbi. There are difficulties of direct trading between emerging market currencies. India and Russia tried to cut a deal where they would settle their own trade using rupees and rubles. They worked for 2 years and it came to naught. And in terms of that single blockchain or digital platform, I will argue that the technological problem has been fully solved, but the political problem to scaling up that kind of system remains. Having said all that, there has been some decline in the extent of dollar dominance, some gradual erosion of the dominance of the dollar. It's tempting, being in Switzerland, to say the dollar's dominance has eroded glacially. You know, the metaphor means the glacier melts very slowly until the tipping point comes. So it is a metaphor that provokes thought. Here I show you what's happened to the dollar's share of allocated global foreign exchange reserves, and that share has been declining from a bit above 70% of the global total at the turn of the century to a bit less than 60% of the global total now. The dollar has lost 0.5 percentage point of global market share every year over that period, year after year. That's the very gradual, almost glacial erosion of the dollar's share. And if you count up the number of countries that peg to the dollar, that number has been eroding very, very gradually. On other margins, trade invoicing, settlement, etc., dominance of the foreign exchange market, you haven't yet seen much, if any, movement. But I would argue, along with other economists, that these different dimensions of international currency status go together. They complement one another. So I would expect activity on these other margins to follow. Why the dollar's dominance has been eroding is clear to see that the US is not as dominant a force as a global economic power and trader as it was half a century ago. There are worries about US indebtedness, about the sustainability of US government debts and our ability to get our arms around that problem of debt sustainability. There are worries about Federal Reserve independence. There are worries that the US has recklessly and excessively weaponized the dollar. There are some outlandish proposals associated with prominent economic figures within the Trump administration to tax foreign holdings of dollars, especially those of countries we don't like. Most fundamentally, in my view, and I can come back to this if there's a demand, there are worries about rule of law, separation of powers in the United States. Will the country remain Will it be well governed in the future? And there are worries about US geopolitical alliances. Central banks and governments hold and use the currencies of their geopolitical partners because they want to show good faith by holding their currencies, because they regard those partners as reliable stewards of their reserves. So if you threaten your partners, raise questions about the NATO alliance, you're implicitly weakening support for the dollar. There's rhetoric versus reality. So the Trump administration recently has said that it values the dollar's international role. Out of the other side of its mouth, it says it wants a weaker dollar. So how can both things be true? I think the answer is they can't both be true. We are all trained to look for a coherent underlying model for such statements, and we may be in a world where or in a situation where there is no coherent underlying model. So if not the dollar, if the dollar's role continues to erode either very gradually or at a faster pace, who or what will benefit? Here's my list of candidates: gold, the euro, the Chinese renminbi, other non-traditional reserve currencies that have not long been on the radar of central banks and other international investors, and a network of interoperable central bank digital currencies. Those are the options I see. My view is that all of these options have serious limitations. None of them can fill the dollar's shoes, if you will, were the dollar to step out of them. Back to gold, there has been much talk about this. I infer there has been an especially large amount of talk about this in a gold refining country like Switzerland. And you can see here the relative importance of foreign central banks' holdings of US treasuries and of gold. Both of these numbers are somewhat dubious because not all central banks report fully what they're holding, but you can see the trend that holding gold and vaulting it at home makes it safe from garnishment, and it can't be frozen. Russia, not surprisingly, repatriated its gold from the West at the time of its annexation of Crimea to insulate it from sanctions and seizure. Problem being that gold is clunky, very difficult to use to settle merchandise trade. It's very difficult to use for financial transactions as collateral. You can't lend it unless it's vaulted in London or New York. So China is working to change this by establishing a gold repository in Shanghai, but it isn't there yet. So the trend in terms of gold is clear, but gold cannot replace currencies in the international domain. The euro was created in part to create an international alternative to the dollar, but this figure from the European Central Bank's annual report on the international role of the dollar kind of looks like the electrocardiogram of a dead person. It doesn't move around very much. At first, there were existential doubts about the survival of the euro. Mario Draghi put those to rest, but Hélène talked about the importance, other people too, about the importance of completing capital markets union, rectifying the problem that there is a shortage of safe assets denominated in euros. Only 3 euro area sovereigns with AAA ratings from all the rating agencies. Last time I looked, no euro area treasury, fiscal policy, significant fiscal capacity at the euro area level, and little ability to project power internationally. So to elaborate what Hélène said earlier, one of the prerequisites for international currency status, in my view, is security. The recipe is size, stability, liquidity of your markets, and ability to defend yourself and your borders. And I think the security element we have seen all through history to be strongly associated with international currency status. So the euro may become more of a player over time, but there hasn't been much movement in this direction yet. The Chinese are actively promoting the renminbi as an international currency, and they too see a potential opening here as a result of new doubts about the dollar. A first observation is that the renminbi is starting out way, way behind the dollar. So there's some figures here that its share of international reserves is like 2% versus the dollar's 58%. Its share in global foreign exchange transactions is barely 10% that of the dollar, and so forth. So its importance along these different dimensions will have to grow at double-digit rates for decades before it comes within hailing distance of the dollar, assuming the US doesn't do something fatally wrong. And why this disparity exists is no mystery. The United States has been actively promoting internationalization of the dollar since 1913. That was one of the motives for creating the Fed. China has been actively promoting renminbi internationalization for at most 15 years. So we've been at it a whole lot longer. They have a long way to go. And if you look at the data, not widely appreciated, renminbi internationalization seems to be stalling out. The currency's share in global reserves has stopped rising. It's now falling, and the same is true of payments through SWIFT, same is true on global foreign exchange markets, etc. Maybe because of slower Chinese growth, maybe because of geopolitical tensions, maybe because of China's own debt and financial problems, maybe because of those questions about China's political governance that I raised before. So too many figures, too many slides, not enough time. The point of this one is that the renminbi does play a role in China's own trade invoicing and settlement, but it plays basically zero role in trade invoicing and settlement among third countries that are not directly engaged in transactions with China. And if you try to reconstruct, as my co-authors and I have, who exactly depends on the renminbi, who holds it as foreign exchange reserves, the answer to a first approximation is Russia. That's the blue slice of the pie. Pie for 80 central banks around the world that report this to the IMF or report it annually in their annual reports. So there's Russia. There's some surprises here to my mind. Switzerland is number 3, according to the data that I have. So I look forward to the dinner conversation to learn more about what has been going on here. The point about the importance of geopolitical links, the fact that Russia holds the currency of its alliance partner, or at least of a country that is studiously neutral in the conflict between Russia and the West. That is consistent with consistent with a long-standing historical pattern where countries hold as reserves and use in payments the currencies of their alliance partners. So the article at the bottom with my co-authors looks back at that history all the way back to the Triple Alliance and the Triple Entente before World War I, where you can see exactly the same pattern. A few words about non-traditional reserve currencies and then about central bank digital currencies, and I will conclude. The dollar has lost upwards of 10% of its global market share in the market for foreign exchange reserves over the last 15 or 20 years. A quarter of what the dollar has lost has been gained by the Chinese renminbi. But 3/4 of what the dollar has lost has been gained by non-traditional reserve currencies. So these are the currencies of generally small, open, well-managed inflation-targeting countries. The New Zealand dollar, the Australian dollar, the Canadian dollar, the Singapore dollar. Why they're all named dollars, I'm not entirely sure. But if they're not named dollar, they tend to be named krona, the Swedish krona, the Norwegian krona, the Danish krona. And there is the Swiss franc hiding there, where if your eyes are good, you can see that it has a small share in global foreign exchange reserves. But the simple fact of the matter is there's not a lot of Swiss government debt out there. That was pointed to as a strength of Switzerland in the last panel, but in terms of the country being an international monetary player, it's something of a limitation. But the general point is that the development of electronic financial markets, platforms on which you can buy, sell, hold, trade these currencies of smaller countries, has enabled central banks and corporate treasurers and others to diversify their reserves in the direction of these currencies. Their share has risen, but even collectively, they lack the scale to substitute significantly for the dollar. Finally, what about a network of interoperable central bank digital currencies? So central banks around the world, with the People's Bank of China being an important first mover, are piloting central bank digital currencies, cryptocurrencies issued by the central bank that are as good as any other form of central bank money. The problem with them at the moment is that they can only be used in country. China's central bank digital currency can only be used if you're resident in China, with very few exceptions. How can they be used across borders? One can imagine linking the central bank digital currencies of two or more central banks. They could all run on a single permissioned blockchain, a blockchain where only the central banks could validate transactions, or they could exist on some other kind of firewalled digital platform where they could be exchanged directly for one another without the need to go through the dollar, the US banking system, or SWIFT. So we have a good example of this kind of platform already. Project mBridge, which is a project of 3 Asian countries, 3 Asian monetary authorities or central banks, and 2 Middle Eastern central banks. The Saudis have joined the UAE. A limited number of transactions have been made through this platform. There's no technical obstacle, it would appear, to scaling it up. But as I said before, I think there is a political obstacle. The question is, how do you organize regulation and governance of this platform? So the participating central banks will have to agree on who regulates the operation of the platform. They will have to agree on who to admit as new members. They will have, the 5 of them have made decisions by consensus. If there are going to be 25 central banks instead of 5, they're going to have to have a voting rule. Will it be 1 country, 1 vote? China is unlikely to prefer that option. Will it be weighted voting as in the International Monetary Fund? What will the weights be? There's a steering committee for Project mBridge, but no specifics on how it will operate. So, and moreover, I think it's unlikely that the United States or any other Western country will be willing to join. What is a People's Bank of China-led project? So the code was written in the Digital Institute of the PBOC. The protocol that validates transactions, the so-called dashing protocol, was written in the Digital Institute of the PBOC. Would the Fed and the US Treasury be comfortable about US banks or even the US Central Bank participating in this system? So I would imagine Project mBridge becoming more important in a financially bifurcated world where the decoupling that we talked about before went considerably further, and Asia, together with energy suppliers to Asia in the Middle East, agreed on further developing this platform. So if none of the above alternatives can fully substitute for the dollar, what happens if there really is a crisis of confidence in the dollar. I'm not predicting necessarily a crisis of confidence, but we have to think about scenarios and alternatives. Central banks are going to, if they want to reduce their dollar risk, and there are not a lot of alternatives to the dollar, the answer is to hold fewer reserves overall. They will do so by winnowing down what they refer to as an investment tranche of additional reserves that they only need under truly exceptional circumstances. Holding fewer reserves in the end will be less capacity to intervene in financial markets and foreign exchange markets. It will mean, other things equal, more volatility and greater expense of financing cross-border transactions of all kinds. So a true full-blown crisis of the dollar would be a threat to globalization, 21st century globalization, as we know it. And we have to hope that the United States, as well as the rest of us, understand this reality and that they remain good stewards of the dollar. So I've kept my promise about being a dismal economist, and I look forward to the conversation.
Thank you so much for that, Professor Eichengreen. I think we all strongly disagree on that final point. Let me ask you about the fact that there have been rumblings about a BRIC currency that could rival the US dollar. Now, obviously, in terms of the liquidity, the depth, I don't know, Mr. Rajan, maybe you agree or disagree, maybe that would work. But do you think that could be a viable alternative?
No, I do not. Think about the euro and all the teething difficulties that the euro experienced in its first 10 or 15 years. Think about the laborious negotiations stretching over really half a century that led up finally to the consensus to create the euro. Now imagine the same issues or problems for a collection of even more heterogeneous countries, even more heterogeneous economically, financially, and politically than the members of the euro area. So I think the BRICS are right to search around for alternatives, to think about whether they can create a digital platform where they can use their central bank digital currencies for direct local currency settlement. But I think BRICS currency is political fiction, social science fiction, if you will.
Mm-hmm. Mr. Rajan, I'd be curious to hear your thoughts about it later, maybe over dinner. Now, you recently wrote in the Financial Times about the demise of the dollar, pretty much summing up, and with lots of history. For everyone who hasn't read it, please do go and read it, because there's lots of interesting historical nuggets about the rise and now the demise of the dollar. Yet, in the end, you say, and this very much struck me, you said that at the end of the day, the fate of the dollar depends on the rule of law and whether that's upheld in the US. Do you think it will be? Can we trust the institutions to do their job in the US?
So I'm an optimist by temperament. You could undoubtedly infer that from the talk. I try to keep my sense of humor at a minimum, but any thinking American would have to admit to being deeply troubled by what's going on in the country. And you would have to be a better prognosticator than I am to have a clear view of how all this is going to play out. Were the state and local elections that occurred on Tuesday an important indicator of what will come next politically in the United States? Who knows?
So you don't have trust in the institutions in the US?
I'm only going to repeat what I said before, that I'm deeply worried about the strength of those institutions and about the threats they are currently under.
Does that ultimately mean that the US is no longer a trusted trading partner, a trusted ally?
I think the trust that the U.S. commands from its geopolitical partners and its trading partners has been eroded by the events of the last year and to some extent events that preceded the year of 2025. I don't think there's any question about that. Where there's a question, interesting question for all of us to ponder is how much of the damage to U.S. institutions and to the trust the country commands globally can be repaired. So we can all imagine a political swing in 2028. Again, I'm not forecasting a political swing back toward centrist U.S. president with conventional economic views, but will things return to the status quo ante automatically if that occurs? I have my doubts. You know, we've seen a demonstration that the separation of powers and rule of law are not as robust in the United States as many of us had assumed. And it's entirely conceivable that there could be future politicians or political social movements that challenge those institutions again. And we have learned that they are fragile and their strength is not to be taken for granted.
I hear your points. Let me challenge you on that, though. Isn't the market, at least, and portfolio managers, and maybe even central banks, aren't they short-sighted in the sense that the dollar and the dollar's dominance, especially when it comes to American exceptionalism, and that does show itself time and time again, that they will want to go back into the dollar, and the dollar is regaining strength simply because of its economic dominance?
I argued in my talk that economic dominance is less than it has been in the past, that the Chinese economy is as large as the US economy, larger when measured at international prices. There are questions about the liquidity and stability of the US Treasury market as a result of tighter regulation on dealers and all the additional debt that has been pumped out into financial markets. So there's long been the view that the dollar's position is secure because of TINA, because there is no alternative. But I don't think TINA is to be taken for granted. There is also this scenario where prudent CFOs and central bank reserve managers worry about their exposure to the dollar, so they curtail their holdings of reserves more generally.
Let's get to some audience questions. I do see lots of them. Could we see a co-dominance of two or more reserve currencies? One group of countries primarily using one currency and another group another currency, something like that?
Yeah, we could see something like that because we've seen that in the past. We saw it in the 1920s when the dollar and the pound sterling were both consequential international currencies. The pound sterling being used throughout the British Empire and amongst Britain's other trading partners in Scandinavia and so forth, the dollar being used heavily in the Western Hemisphere and some other parts of the world. We saw it before 1913 as well. So people talk about the gold standard and the dominance of gold as international money before 1913, but currencies were also being used internationally, notably the pound sterling, but also the French franc and the German mark. That kind of multi-currency world functioned relatively smoothly before 1913 because the central banks and governments responsible for those currencies followed broadly sound and stable policies. In the interwar period, that system functioned terribly and collapsed in the 1930s because the issuing entities did not follow stable policies. So is a multiple international currency world stable or unstable, good or bad? The answer hinges on the management of those currencies by the issuers.
You mentioned the word stable. Let me just pick up on that. On stable coins, something that Helen has already talked about, and we know that 99% of stable coins are backed by the US dollar, US treasuries, obviously. So isn't that already the newly emerging reserve currency?
That's a very optimistic take on the effects of the Genius Act and the ultimate use of stablecoins. So, at the moment, we know that stablecoins are mainly used for two things, three things. Number one, as on-ramps and off-ramps to other cryptos. You buy a stablecoin and warehouse your funds there until you're ready to leap into the Bitcoin market, or vice versa. They are used to a limited extent for remittances, and they're used for illicit transactions. So is that the basis for a dominant global currency? I think not. We will have to see them move into the mainstream of payments, and we haven't seen that yet. I have my doubts about whether the Genius Act lays the foundations for them moving into the mainstream of payments. We don't know whether stablecoins will be stable at the end of the day. At the moment, we don't know whether stablecoins will be fungible at the end of the day. So retailers like Amazon and Walmart want to issue stablecoins. Will Amazon coin be usable at Walmart and Walmart coin be usable at Amazon? And which one will you all want to use? And stablecoins are still clunky and time-consuming to use in the international sphere. So you have to take Swiss franc and on-ramp it, upload it to a Swiss franc stablecoin, and then download it to a US dollar. Even for the digitally adept, I exclude myself. That can be a time-consuming, difficult task.
Do you worry about what stable coins and its emergence and its popularity does to the authority of central banks? Does it undermine the authority?
Well, certainly in emerging markets with significant inflation problems, it will be a source of currency substitution, which will erode the effectiveness of monetary policy. In countries like the United States, I worry more about the potential implications for financial stability. So the assumption in the Genius Act is that each of the 54 potential regulators of stablecoins, the comptroller of the currency, the Fed, 50 national bank regulators, and others whom I've forgotten, all of them will be perfect in their regulation of stablecoin issuers, and we won't see problems like we did in 2023. Silicon Valley Bank failed. Circle, a stablecoin, had lots of its reserves at SVB, and holders didn't know whether they would be able to recover those. The coin went to a big discount. The analogy with primary reserve fund, the big money market fund that broke the buck in 2008, it held its reserves in US treasuries. That analogy is direct as well. And if there's a run on stablecoins, there will be large-scale liquidation of the US treasuries that they hold as reserves. So what goes on in the stablecoin sphere may not stay in the stablecoin sphere.
Let's get to more audience questions. Anyone in this room with a question? I see someone here and in the back. Sorry, the young gentleman was first, Joachim, sorry. We'll come later.
Yeah. I assume a worst case where the dollar decreases a lot in trust in the near future, what would be possible scenarios?
What would be the possible
scenarios?
Scenarios. Well, I think you're asking about potential triggers for that happening, or about the fallout from the consequences of it happening, and you're free to say both.
Yeah, I think you mentioned potential triggers, so I'd be interested in fallout, hypothetically.
Well, I think the potential triggers center both on U.S. economic and financial policy on the one hand, and U.S. politics, foreign geopolitics on the other hand. So more crazy proposals from people associated with the Trump administration to tax foreign dollar reserves or forcibly convert foreign U.S. Treasury bonds into century bonds bearing an artificially low 2% interest rate, I think could potentially trigger more rapid movement away from the dollar. In the medium term, and the medium term is growing closer every day, there are doubts about the capacity of the U.S. political system, as I said before, to get its arms around what is increasingly looking like an explosive debt to GDP ratio. That plus threats to the independence of the Fed do raise the specter of inflation and dollar depreciation, which can rightly scare international investors. And I think that we have already seen how these threats, especially when they're directed at countries that the US or the current administration views as geopolitical rivals, such countries, including China, have been trimming their holdings of US treasuries. And what has been slight trim could turn into, I'm mixing my metaphors here, could turn into a buzz cut.
Quick one here.
Yeah, so you made a very eloquent case for the importance of the political system and stability for the continued dominance of the dollar. But if you think about the rise and peak of dollar influence, you have two things that I think much closer to the actual functioning of the dollar that basically only registered as a small blip. I'm thinking of 1933, the cut in the gold content of the dollar, and then the end of the Bretton Woods system, both of which I think had we sat on a podium back then, you would have probably said would be catastrophic for the reserve status of the dollar, and which turned out to be entirely compatible with its peak of influence.
So yes and no. The first episode, the 1930s, the dollar's international role did collapse in a heap. So the, if I recall my statistics, the dollar's share of global reserves fell by 2/3 after 1930. So that was a consequence mainly, I think, of three major banking crises that were mismanaged in the United States. But there was also an unexpected devaluation and abrogation of the gold clauses, preserving the gold value of U.S. treasuries. So the dollar's international role did not survive those events, but the dollar gained a second life fortuitously as a result of World War II. So those words should not go together, but in the monetary context, they do. Many wise people were surprised by the fact that the dollar did, however, survive the collapse of the Bretton Woods system. So I'm reminded that the monetary sage Charles Kindleberger said the dollar is done in 1975 as a result of the events of 1971-73 when the Bretton Woods system collapsed. The dollar benefited from TINA, the fact that Germany used, the Bardepot And the Japanese used capital controls to prevent people from shifting out of the dollar into the only available alternatives. And all that happened in 1971 was that the dollar's convertibility into gold at a fixed price was extinguished, if you will, but the dollar's other values were maintained.
A final question from the audience, and I think this is a very pertinent one. What skills do you think young economists should develop over the next decade? You need to make a good case for your profession here.
What can young economists do that ChatGPT cannot? I think the economics profession is moving, broadly speaking, in the direction of big data as opposed to abstract theorizing. And given the dominance of abstract theorizing for some decades after World War II, I think this rebalancing is a good thing. Unavoidably, I will say, try to develop a historical sensibility, something that you can't gain only in a statistics course, but and something that you have to gain on your own, as opposed to gaining it in business school or economics graduate school or whatever.
Will the best and the brightest economists still flock to the U.S.?
We're doing all that we can to continue to attract them, but we are facing certain political headwinds.
It's not going very well. Switzerland? It's a beautiful place, let me tell you. You've seen this, right? It's never too late.
I'm here today.
We'll take that, and of course, we thank you for your time, Professor, and we honor your input. Thank you so much. Thank you so much. And this wraps up this UBS Center Forum for Economic Dialogue. I hope you enjoyed it as much as I did. As always, I do learn a lot from hosting this, so thank you so much for your questions, for your time, for your interest. And there will be further events, webcasts by the UBS Center. If you're on the mailing list, you will be contacted about this. Again, a big thank you to everyone who was involved. A lot of effort goes into putting together the guest list and the event. And thank you for your time. Appreciate it. Have a great evening. Thank you.